So in continuation of our series from Bill to Practice, so today we are going to talk about from our eminent speaker, Cotha Srinivas, is going to talk about the capital gains. So I request CA Vinod Garg, SICASA chairman, to escort today's speaker, CA Cotha Srinivas, to escort him onto the dais and hand him over a book as a book acknowledgement. So, as you all know, it is a continuation of the series of From Dream to Practice. So there are quite a few practical changes which has been observed, which you might have already observed in the previous two sessions, where we spoke about the transition provisions, salaries, and housing property. Now we have moved on to the next part of it, the capital gains. So for this, we have, as I said, a very eminent speaker, CA Cotha Srinivas. So it is my privilege to introduce him for today's forum. CA Cotha Srinivas is a BCom graduate from Bangalore University and a fellow member of ICI and also member of Institute of Cost and Work Accountants of India. He is a founding partner of SSB and Associates Chartered Accountants. He has served the institute for over 2 decades in various positions, starting from the student committee to the Bangalore branch, where he served also as a chairman of Bangalore branch, and served 9 years in the regional council, where he was the chairman of SIRC, and he has also served 1 term in the Central Council member, as a Central Council member. He has presented various papers at study circle meetings, workshops, seminars and conferences on topics covering direct tax and international taxation. He is also visiting faculty at ICI Bangalore. Authored a book named CA Referencer for Chartered Accountants, which was released by Bangalore branch of ICI as a study circle series booklet. He is a life member of KSCA, he is a life member of BCS, and he is also the founder of Group Dynamics of Study Group on International Taxation at Bangalore and Chennai. So, and also he has contributed a lot in his capacity as a regional council member as well as central council member. Few key observations were he has got approval for construction of COE, which you might be knowing, the Rajajinagar branch, so which was a great effort which was put by CA Cotha Srinivas, and also declaring results within 45 days. So that was also kind of introduced by Cotha Srinivas when he was heading WS. Instrumental in introducing 3 examinations for inter and foundation. So these are the few highlights of his contribution as a member of SIRC as well as Central Council member. With this brief introduction, I present before you today's speaker, CA Cotha Srinivas.
Namaskara. Welcome you all to this series of programs on New Income Tax Act organized by Bangalore branch. Today we are in this third leg, where we will be discussing on capital gains. First of all, I should thank 2 ladies, I should say. One is the Finance Minister, who introduced this New Income Tax Act 2025. Otherwise, we wouldn't have bothered to open the Income Tax Act until unless it is required. Of course, next is the chairman, Kavita, who invited me to come and address the members. First of all, it's a great opportunity for all of us to open the Income Tax Act once again. I'm not saying that we will not open, but we will not read the entire Income Tax Act. How many of you have read the entire Income Tax Act recently? I have read 30 years back when I was doing my CA final. So I would have read the entire Income Tax Act. Prayer Act I used to read in 94 or 96 when I did my CA final. I was reading the Prayer Act. Afterwards, I have never attempted to read the entire Income Tax Act 1961. It's a great opportunity to all of us now. The new act has come. Even though we say that nothing has changed, but there are a lot of things which we have to see in the new act. We should, one way we should thank Finance Minister for bringing this. But what is there in that, only once we get into the Income Tax Act, we'll understand. Today we are discussing about capital gains. These are the contents which I thought I would plan to share with all of you. The introduction, the chargeability, capital asset transfer, computation exemption, miscellaneous provisions and if time permits, the practical challenges. Some of the practical challenges I just noted down. If you are interested, if time permits, so I thought I will cover all those things. If you see, I just sent this presentation to one of my friend to just see how it is. He said it has come out very well and you may require minimum 6 hours to cover this. So I don't have 6 hours to discuss today. If I go through each and every slide, definitely it will take more than 6 to 7 hours. In 3 hours, whatever best possible, I will try to cover. And few things I will give homework for you. You have to study. Everything if you want the speaker to come and study this will not work out. So few things maybe you can also lay your hands. First thing first, if I have to say, this is the first time I am presenting a paper on Income Tax Act 2025 capital gains. I've been talking on profits and gains of business or profession last 2 months. Maybe it started on 18th of April 2026 at SIRC till last week. I think I've traveled almost around 20 branches across all the southern region to speak on profit and gains of business or profession. But this is the first time I'm speaking on capital gains. Of course, I used to teach income tax in the branch for the students. I used to, it's one of my fond hits of income. But for members, this is the first time, and especially the new Income Tax Act 2025. When I say first time, I remember some incidents where a doctor entered the operation theatre to do an operation and he saw that the patient was very tense. So doctor said, why are you so tense? It's a small operation, but still he was very tense. On subsequent inquiry, the patient said, this is my first operation. Doctor said, don't worry, this is also first operation for me. So there is no need to worry on this particular operation thing as such. So why I am saying this is, whether I speak or someone else come and speak here, Income Tax Act 2025 is new for all of us. For me also, for the speakers also, for you people also. So together we should learn at the end of 3 hours or 3.5 hours, whatever we spend today. We should learn, both of us should learn something more and go out of this particular hall. Couple of years back, there was a meeting in Delhi where Finance Minister was addressing all the top officials of this country. The principal commissioners, chief commissioners across the country were present there. They had some, some award function or something like that for all the principal commissioners. So the invitation came to us also. I was in Delhi at that point of time. President said we're going to join me. So I was at that time the vice chairman of DTC. I went there. She was mentioning about 3F, that is the intention of the finance ministry. One F is faceless, the other F is fairness, and the third F is fearlessness. The faceless, already it has been there, implementation said, already it is removed from past couple of years, all of us are aware about that. Fairness, she was mentioning that it should be fair to the taxpayers, whatever the legislation we make, should be fairness to them. And even it should be simple for them whenever they come and read they want to get into the Income Tax Act. And she also, if you see in the recent budgets, there were some amendments in Finance Act 2026 where some of the prosecution proceedings, which were rigorous imprisonment, has become simple imprisonment plus fine and all. So that also, if we see all these things, and when we see this new Income Tax Act which has been introduced, which is considered as a simple law compared to the old 1961 Act, we can say some fairness was thought about and they have been implementing that fairness. At that point of time, we were not aware that new income tax bill used to come. But when she said, when we see all these happenings, maybe that fairnessness is what she meant has come into reality now. The third, if she said fearlessness. Fearlessness means any taxpayer, he should not be afraid of coming to the income tax department or paying the taxes. So whenever he gets a notice, he should not be afraid of coming to the income tax department. And she was also telling to the department officials that you should also be fair to the taxpayers. You should, whenever somebody comes to the department, you should be fair with them, should be cordial with them, and you should receive them so that they will also feel safe under the hands of this department. So this is what happened, and maybe this is the I should say the happenings that have happened, so events that have happened, which has brought into this new Income Tax Act 2025. They say it is simple. When once you start reading, you'll understand whether it is simple or complicated. And this time only will say. I cannot say today whether it is simple or complicated. Over a period of time, you'll understand whether it is simple or not. But one thing we can notice, one of the officers in SIRC, when we had a meeting, he was addressing that. He was part of this exercise. He was telling that if you read any sentence, any section in the Income Tax Act 2025, there won't be any full stop. There only commas will be there, at the end there will be full stop. So you will not get two sentences in a particular subsection. That's what he was mentioning. I have not done the R&D. So if anyone of you are interested, or if you can do the R&D, you can let me know if there is any. Whatever sections I have tried to see, I have found that there is no full stop in between. So entire sentence will be there, in between there will be comma, it will end with the one sentence almost. So that is what they have done. So let us see how it works. First let me take you through some of the introduction aspects. So the legislative timelines, almost all of us are aware about this. It was announced on 1st February, and then 13th of February original IT bill was introduced, and it was withdrawn on 8th August. So it was introduced in February and it was withdrawn on August 8th. The reason being, there were a lot of suggestions that came, almost more than 25,000 suggestions came. There was a parliamentary committee which was reviewing all these things. They thought instead of implementing all those things, they thought that they would withdraw this. And 11th August, a revised IT number 2 bill was introduced. Then it was passed in Lok Sabha on 12th Rajya Sabha, then presidential assent came, and then 21st of August it got notified. So Income Tax Act 2025, what we are talking about, or got notified on 21st of August 2025. Then Union Budget was presented again in the year 2026. As usual, the annual affair, 1st February, Union Budget was presented. And there were many changes in the Union Budget. What was the reason for changes in the Union Budget? Even before it was implemented, there was changes in the Income Tax Act 2025. One of the reasons being, there were many things which was there in 1961 Act which was not copied or incorporated as it is as such into 2025. For that they made the changes. And some of the things like I said, penalty prosecutions and all, where they wanted to reduce it, they changed in both Income Tax Act 2025 and Income Tax Act 1961. And few changes were made both in 61 Act and 25. To tell example, like they changed the due dates. Earlier it was only July, October and November. Now July, August, October and November has come. So those changes were made. This was passed, and President assent was obtained on 30th of March, and 1st of April Act became effective. So 1st of April, two things happened. One is Income Tax Act 2025 became effective, and the same day Income Tax Act 1961 was repealed. So repealed doesn't mean that it is removed. So it is repealed, that's all. So still it exists. We have section 536 which talks about repeals and savings. So whatever is there in 1961 Act, which are the proceedings that were there, or so many things which was there, will still continue in the 2025 Act. Then rationale behind the new Income Tax Act, complexity to clarity. That's what the main purpose of this. Extensive amendments. 1961 Act came 65 years back, and almost 4,000 amendments have happened to that 65 Act. So they thought it's time to revisit this and have a new Income Tax Act. Then fragmented structure and outdated provisions. So we see even 2-3 years back we did it was as per ICA, we made all this work and we sent it to CBDT. What all the redundant provisions, what all the omitted provisions and all we sent. At that time also we didn't know that new Income Tax Act 2025 is coming. So we just sent whatever they asked, we just gave all those details, and even numerous exemptions and deductions are there, and some of the jargons, traditional legal languages are there in 1961 Act. Now if you see, it's very simple. The words are very simple, and they want, the main purpose of bringing this Income Tax Act 2025 to make it simple is for, one is for the taxpayers, second is for the administrator, the department, not for chartered accountants. So the act is not made simple, or intention of made simple for chartered accountants. They brought this simplification law for taxpayers and the administrators. Of course, for us also it will be simple. And as a professional institute and as chartered accountants, they have duty and endeavor. Now it is being the law, so we have to also understand this Income Tax Act 2025 before going to the clients. So we should understand and also educate the clients about the new Income Tax Act 2025. How many of you purchased Income Tax Act 2025? Oh, quite a huge numbers are purchased. How many of you still you are not opened the book? I think. Anyway, you can do that also. So our DTC is releasing, brought out the publication both for Income Tax Act and Income Tax Rules. If anybody is interested, you can get it the CDS portal. 500 rupees is the Income Tax Act and 700 rupees is the Income Tax Rules. So DTC is released publishing that Income Tax Act and Rules. If you are interested, you can subscribe and you will get it. So the threefold framework: eliminating intricate language, removing redundant and repetitive provisions, then reorganizing provisions logically. Some of the places, if you see, this provisions have been organized logically. Some of the places they have done some exercise for this. And if you see TDS provisions, so how many sections are there in TDS? In India, 1961 Act. Huh?
About 700.
No, sir. TDS sections. How many are there? And I'll be asking questions, you have to keep answering, otherwise it will be difficult to hold you for 3 hours. How many sections are there under TDS?
Maybe about
30, 40, okay. Now we have only 2 sections. So maybe 40 sections. How many, we remember how many of sections we remember as chartered accountants? Our articles may remember more. So we may remember 10 to 15. So articles may remember 20, 25. So now it is only 2 sections, 392 for salaries and 393 for all the remaining. Then 3 guiding principles, textual and structural simplifications, all the things like they have brought it in the form of tables, formulas. So many places like section 10, so many sections are there now, everything has come to the schedules. So only one section is section 11. Everything has come to schedules, almost from 2 to 8 or 9 schedules have come. So everything, in 10 I think there were almost 100 exemptions were there. 10, 50 like A, B, C, D and all, if you count, almost 100 and 101 deductions were there and exemptions were there under section 10. Now everything has come into the form of schedules. So no major tax policy changes. Of course, under 1961 Act also, we were charging income or taxing income. Under 2025 also, we tax the income. There is no change in that. And the tax rates, the OTR and NTR, what was there in 1961, same thing continues. The slab rates, surcharges, everything is same as on today. Core objective simplification. So replace archaic language, digital integration. So a lot of digital integration has already started, like faceless assessment, like faceless appeals and all has happened. And going forward, still there may be more integration. Like AI integration may be there. AI is a universal thing. It's not only for chartered accounts available. Even for client it is available. Even for income tax department also it is available. Going forward, if they integrate all these things, as such we know today, department has got 360-degree information of each and every one of us. We may not be knowing where we have invested, where we have spent. They will have entire details. So if they start integrating all those things with the systems, the time is not far that tomorrow a pre-filled form may come for small assessees, which they have only salary and so few interest income. The pre-filled form may come. If you say submit, it may say this is the tax you have to pay, or it will say this is the refund it has to be, you will receive. And if you have to pay the tax, you can pay the tax. Refund means you can submit online. So the time may be there, maybe 1 or 2 years down the line. The pre-filled form may comes for small assessees, where they themselves they can open and file the returns. Then taxpayer-centric approach and global alignment. Whenever they do some new things, they thought they will have certain global implications on that or that. Some at least they will say that we have studied some global tax laws. So they have studied Australian tax laws and UK tax laws. So whenever you say that we have already studied the global impact or global taxation, we also feel that yes, we are also in line with the global tax systems. So those things also they are done. Now, this is a simplified framework of Income Tax Act 2025, where the sections are reduced, the schedules are reduced, schedules are increased, rules have reduced and forms have reduced. Now the next question to all of you. How many sections are there in Income Tax Act 2025? And how many alphanumeric sections are there? Huh? Zero. So whatever you said, the answers were right in August 2025, but today both the answers are wrong. Because in Union Budget 2026, again I said there were a lot of amendments. So two sections were omitted. Before it was implemented, two sections got omitted, 443 and 447 got omitted, and one new section was added, that is 354A. So today if you ask, we have active 535 sections and one alphanumeric section is there. But of course 536 is the last section. General public may not know, but as we should know, 535 is the active sections, 536 is still the last section. One of the key features is introduction of tax year. Earlier we had previous year and assessment year. Of course, right from the day we started CA or whatever BCom and we started studying income tax, we have been studying previous year and tax year. There is no change in the definition of previous year and tax year except that terminology. So it's a period of 12 months starting from 1st of April to 31st of March. And simplified compliance, as I said, multiple provisions have been brought together for more clarity. Example, TDS. So I said there are almost 40 sections were there. Now it is only 2 sections. 392 is for salary and other related employee contributions. 393 is for all the other deductions. 393 subsection 1 deals with the payment to residents. 393 subsection 2 deals with payment to non-residents. 393 subsection 3 deals with payment to any persons. Any persons include both residents and non-residents. But if you go to 393.1, 93.2, 93.3, there are tables. So in tables you have to remember the serial numbers. So for that you should start watching the serials, so that we can correlate this serial to this serial. Because every table has got 7 to 8 serial numbers. So you should not watch serials only on one channel. 2-3 channels you should identify. So 6 o'clock which serial comes. So that serial you should, I think probably you should match, because it's Herculean task to remember this. We used to remember, as I said, 10 to 15 sections. Any one of us will remember. Now to go and remember the section, serial number, I don't know, it may take some time. That is simplification what has happened. Digital first enforcement, virtual digital space has been defined and scope of virtual digital asset has been broadened. And dispute resolution, introduce a more robust and taxpayer friendly framework for resolving disputes. More taxpayer friendly framework for resolving dispute has come, but at the same time I may expect more and more notices to come. Because as I said, digital integration in future, we can expect more and more notices, like GST, I will take a lot of notices. Tomorrow more and more notices may come when once everything has been integrated. And going forward it is so much difficult. If you see, like earlier for filing this foreign tax credit, claiming the foreign tax credit, we used to file Form 67, right? So just we used to file before filing the ITR return. Now it is Form 44, which has to be certified by chartered accountant. So entire burden has been shifted onto the chartered accountants. It's not that just you file Form 67 and keep quiet. So you should ensure that everything is proper. So like that, more and more burden has been shifted to chartered accountant. Now we saw here, forms is 190. Earlier it was 399, now it is 190 forms. Now I just made a list to see which are all the prominent forms that needs to be certified by chartered accountants. Out of 190. The first one is form 28. This is with respect to capital gains, computation of capital gains for slump sale. Earlier it was 3CA, now it is form number 28, which is a report. Then we have form 26, tax audit report. Now we know this, we have 3CA, 3CB and 3CD. Now all the three combined is form 26. Form 26 has got 4 parts, A, B, C, D. Part A is 3CA, Part B is 3CB, Part C is Part A of 3CD, Part D is Part B of 3CD. So all put together is one form, and I think form 3CD we used to have some 44 items, right? 44 things were there. Now it is 53. Going forward it is 53 and with 10 to 12 schedules, and they expect everything from us. So everything, it's not just a true and correct, more than that also they ask now. And since there's a digital integration happens, so that it can identify where is the mistake, what is the mistake. So where if you have to write yes, it may ask why yes. If you write no, it may ask why no. Or if you write nil or not applicable, where you are supposed to write yes or no, then again it may ask you a question why you have written nil or not applicable. So this is the more and more burden that has been shifted onto the chartered accountant. Then we have foreign, as I said, foreign tax credit, where we used to just file 67 and claim the foreign tax credits. Now 44 has to be filed, where it has to be certified by a chartered accountant. So all the companies which are claiming foreign tax credit has to be certified. Other assessees, if you are claiming foreign tax credit of more than 1 lakh, that needs to be certified. And then we have transfer pricing report 3CEB, which is 48. Then for book profits, MAT credit and AMT, which was 29B and C, now it is 66 and 67. And these are some of the other forms. Then we have Form 10B or 10BB for charitable institutions. We file this year 10B or 10BB. Now it has become one form, that is Form 112. And payment to non-resident of a foreign company, where chartered accountant has to certify 15CB. Now it is Form 146. 15CA is 145. 15CB is 146. But 15CA we are not certifying, so I have not put that particular thing. This is only the forms which a chartered accountant has to certify. So totally out of 190 forms, chartered accountant has to certify 35 forms. So there are 190 forms, 190 we need not worry about that, only 35 forms, and all the 35 everybody will not certify. Whichever is important for us, whichever comes to our client, this needs to be done. So why did I do this exercise means from DTC they sent me a mail asking me to review all these forms which needs to be certified by chartered accountant, because we have to update the UD. Because once you go to UD, you have to select these forms. So then I went through all the 190 forms. I didn't read the 190 forms. Last I read whether chartered accountant to be signed or not. So that way I went through all the 190 forms and I just made a list of all these 35 forms is what we need to certify. So I have given the entire list, and 36 the number also I have given. Any certificate or reports. So if you see the type C and R means that is the certificate or report. So last 36 I have sent one more thing. Any other certificate or report. One thing I would have missed in 190, or there will new things may come in future. So 36 list, now it may be updated in the UD in a few months. So for that also we have suggested that a separate drop down should be there for UD. In UD we have 3 drop downs. One is certificates, one is audit and assurance, one is GST and tax. I suggested one drop down for income tax. Now they have removed GST recently, only income tax has come. In income tax there may be 2 more classifications. One is Income Tax Act 1961, the other one Income Tax Act 2025, where we may get all these 36 forms. So that may come in future. So this is the introduction part. Oh, some more things are there. Okay. So now we are covering this capital gains, Chapter 4E. In 1961 Act also it is Chapter 4 which deals with heads of income. Here also it is Chapter 4 which deals with heads of income. Chapter 4A is heads of income, 4B is salary, 4C is house property, 4D is business or profession, 4E is capital gains, and 4F is other sources. So there is no change in the chapter heading, that is 4E. The sections covered here is 67 to 91, around 25 sections. Rules covered of 49 to 58, around 10 rules. Now the next question. In 1961 Act, we have 5 heads of income. Now also we have 5 heads of income. Can you tell me the range of sections covering all the heads of income? The starting section of income from salary, the last section of income from other sources under 1961 Act. First section of income from salary, last section of income from other sources. 16 to 56. Then any other? So there is no negative marks for wrong answers. And if you tell the right answer in the break, you may get an extra coffee, snacks. I'll ensure that you get that. So you can attempt as many times as possible. Huh? 15 to 57, 15 to 56. So in reality show, no, we'll go. The nearest number will be a prize. So like that I should get now. Still I can get the right answer. Both I want the right answer. First and last. So 15 to 59. Nobody gave the answer, right answer. 15 to 59. First section of salary is 15. The last section of income from other sources is 59. Wrong, da?
69.
Started with 69.
No.
What is?
No, not unexplained income. Income from other sources. Not not gone to other things. Not aggregation and all we are talking. Heads of income, chapter 4, 15. Heads of income starts from 15, it ends at 59. Correct, na? So now in income tax act 2025, it starts from 15 only. But 59 you have to read reverse. It goes up to 95. So 15 to 95. It was 15 to 59, now it is 15 to 95. So the important definitions under chapter 2 are just made out of section 2. Section 2 is a definition section which defines around 112 terms. Section 2 defines 112 terms. So I just picked some of the important things for with respect to capital gains. Now section 67 to 91 deals with capital gains. So what are the sections in 1961 Act?
45 to 55.
45 to 55A. So there is no change in the number of sections. There is no change in the number of sections. If you count from 45 to 55A, if you count, the same will be there in this one also. The thing is, alphanumeric has got a new section now. So it's easy to remember. So 45 starts from, 45 means 67, 46 is 68, 46A is 69, 47 is 70, 47A is 71, 48 is 72, 49 is 73, 50 is 74, 50A is 75, 50AA is 76, 50B is 77, 50C is 78, 50CA is 79, 51 is 50D is 80, 51 is 81, then 52, 53 was omitted. So 54, the deductions, exemptions will start. 54 is 82, 54B is 83, 54B is 84, 54EC is 85, 54F is 86, 54G is 87, 54GA is 88, 54H is 89, and 55 is 90, 55A is 91. So it's to correlate like this from 45 to 67 should start and it ends at 91. If you remember all the sections, it's very easy to remember the old section and the new section. So whichever is there active in 45 to 55, there is no addition, there is no deletion. So wherever alphanumeric section is there, you have to add one more sections. Now let us start with capital gains. So the chargeability, the capital asset, transfer, computation, then exemptions, and then I said one more is practical issues. So we start with chargeability. Of course, as I said, takes a lot of time. So some of the things I may skip for homework for you, but everything is there in the presentation. So once you get the PPT, you can go through that, everything will be there. So section 67 is capital gains, 68 is capital gains on distribution of assets, and 69 is capital gains on purchase by a company of its own shares or other specified securities. In fact, this buyback of shares last year was dividend. All of you must be aware. 222F in the old act and 240F in the new act. So in August 2025, they introduced 222F. Buyback of shares was considered as dividend, So the same thing was introduced in 240F in August 25 and this, but when this act came. But when Finance Act 2026 came, 240F was removed and 222F also was removed. So now buyback of shares is again a capital gains, it's not a dividend. In fact, only for 1 year it was a dividend. Like only 1 year we conducted 3 exams for final. So now back to only 2 exams for final. So like that, it was a coincidence, both ICA and what you call this income tax department, the same year we did. That is a calendar year, this is a financial year, so 25. So which was buyback of shares was dividend, now it is back as capital gains. So chargeability, section 67(1), any profits or gains arising from, there is no change in the definition of chargeability. It was 45(1), now it is 67(1). So just to recap, just I am reading that. Otherwise 1961 Act here, wherever changes is there I will tell you, but otherwise not much change. Any profits or gains arising from the transfer of a capital asset, so there should be a capital asset and should be transferred to arrive at the capital gains. Affected in a tax year, there it was previous year, now it has become a tax year. Same as otherwise provided in sections, all these sections. In fact, here if you see, I have marked in green, that is 85 and 88. So earlier sections, earlier 1945 subsection 1, it was not mentioning 54 EC and 54 GA. So those sections were omitted. Even though we were claiming exemptions, in the charging section if you see, 54 EC was not there, 54 GA was not there, some of the things were not there. Now whatever the 7 exemptions are there, everything has been covered here. They have brought that also, 82, 83, 84, 85, 86 and 88 and 89 also be chargeable to income tax under the capital gains and shall be deemed to be the income of the year in which the transfer takes place. So the main things which we have to see for charging anything as capital gains, one is there should be a capital asset and it should have been transferred. When it should have been transferred in the previous year, oh sorry, tax year, you are right. So I learned that. So in the tax year it should be transferred and assessee should own that and it should not be specifically exempted under these sections. So these are the main parts or ingredients of a charging section where we should have a capital asset, transfer, the tax year and profits and gains arising out of that and should not be specifically exempted. And if you see, these are the sections I have just given for capital assets, transfer, tax year, profits and gains and exempted. So this is the general charging section which was there in 45(1) also. But for this there are certain exceptions. There are certain exceptions for this basic rule. So some 7 to 8 exceptions are there. Let us see what are those exceptions. First one is 67(2), earlier 45(1)(a). Now it is 67(2). So any person receives during any tax year from the insurer money or other assets under an insurance due to damage or destruction of any capital assets under various circumstances which has been defined as section 67 subsection 3, like it may be natural calamities or any civil disturbance or action taken by an enemy or combating enemy. All these cases, if you receive either money or other assets from an insurance company, what you have to receive? Any profits or gains arising from receipt of such money or other assets, it is deemed to be income of such person of the tax year in which money or other assets was received. How to compute? So the basic exception what I am saying is, so if there is any natural calamities like this, there may be an insurance claim. Year 1 there may be any mishappenings is happening, either damage or destruction to the assets. You are surrendering all your assets. So when once you surrender your assets to the insurer, there will be a transfer, but it will not be subject to tax in that year. The year it will be subject to tax is when you receive money or compensation from the insurance company. So full value of consideration is equal to value of money received. So whatever money you receive plus the fair market value of other assets on the date of such receipt. So money if you receive in the form of money, the same value, or sometimes you may receive replacement of asset. So the fair market value. Sometimes you receive both. A partial portion of money you may receive and some of the assets you may receive. So both put in the fair market value of the asset plus money, the year in which you receive, then you have to charge to tax another at capital gains. Then we have this is a receipt including bonus under unit-linked insurance policy, where exemption is not allowed for the policies. The tax year in which amount is received is subject to taxation. Computation is given in Rule 49. Then 67(6) is this conversion of stock in trade into capital asset. When it will be charged to tax? So whenever the conversion happens, it is considered as transfer. If you go once we see the definition of transfer, it also includes conversion of capital asset into stock in trade. So it is a transfer. But when it will be subject to tax? When finally the stock in trade is sold. So this is again one exception to the main rule. 67(6) it was 47(2), 45(2). Then 45(2)(a) is with respect to shares and the securities. When you keep your shares and securities with a depository or participant, legally they are considered as the owners. The people who keep that, the investors who keep that are considered as the beneficial owners. So legally they are the owners. It will not be charged to tax in their hands, but it will be charged to tax in the hands of beneficial owners when they sell the shares. And the system is on FIFO basis. So here also the main exception to the main rule is it should be charged to tax in the hands of the assessee who owns the capital asset. So here legally they are considered as the legal owners, but it will be charged to tax in the hands of beneficial owners on FIFO basis. This was 45(2)(a). Then 45(3), now it is 67(9), transfer of assets from member or partner as a capital introduction or otherwise in the firm AOP or BOI. So this was there earlier 45(3). Whatever you charge in the books of accounts of the firm or BOP, that will be considered as a consideration in the hands of the person who brings these particular assets. Then 45(4), specified person, that is a partner or a member, receives during the tax year from a specified entity money or capital assets or both. So on the occasion of reconstitution of a particular specified entity. So under reconstitution of a specified entity, any specified person receives money or capital assets or both. It will be charged to tax earlier in the 45(b), now it is 67(10). The nature should be deemed to be capital gains, the chargeable in the hands of specified entity. When the assets are transferred from the specified entity to the specified person, it will be charged to tax in the hands of specified entity. The year in which that specified person receives these assets. Whenever the specified persons, the partners or members receive these assets, in that year it will be subject to taxation in the hands of the specified entity. How to compute is amount chargeable is equal to money received by the specified person plus FME of capital asset. So if he is receiving money, the money will be the value. If he is receiving the asset, the fair market value of the asset on the date of receipt minus capital balance. So the capital balance in the firm or AOP, that will be the considered as a cost of acquisition. So balance will be charged to tax as capital gains in the hands of specified entity. And this talks about only reconstitution. It won't talk about any other situation. So it will not talk about dissolution. Section 8 talks about both reconstitution and dissolution. Section 8 is there where it talks about both reconstitution and dissolution, but 67(10) talks about only reconstitution. And if A is negative, that is 0, you cannot take it as loss from capital gains. So in this situation, if A is becoming 0, that is A is equal to B plus C, whatever we are saying. If A is 0, that is B plus C is more, A is less, then we cannot take it as negative and claim loss from capital gains. It will be 0. So balance in the capital account, do not consider increase due to revaluation of any asset or self-generated goodwill, any self-generated asset. So if the capital balance is increased by revaluation of any asset or self-generated goodwill or any other self-generated asset, that should not be considered in the capital balance, that has to be reduced so that you can arrive at the actual capital gains in the hands of the specified entity. And section 6710 shall operate in addition to the provisions of section 8. So it says both the provisions should act independently. So there may be a situation where there is a reconstitution of a firm or AOP and capital assets are distributed to the specified person. He may be subject to tax both under section 6710 and also under section 8. So both they say it should be work independently. So there may be a situation where it may be taxed both under section 6710 and under section 8. Then 6711A gives the definition of certain things. The specified entity means a firm or other association of persons or body of individuals, excluding the company and cooperative society. Whenever firm comes, the name firm or partnership. Section 245 defines firm and 275 defines partnership. Okay, so both the definitions are same except the first word. In 245 it starts from firm, in 275 it starts with the word partnership. Means any partnership form registered under the Indian Partnership Act 1932 and an LLP registered under the LLP Act 2008. Both the definitions are same. So whenever in the Income Tax Act you come across the word firm or partnership, it includes both partnership form and LLP. A specified person, a member or a partner of firm or AOP or this thing. Reconstitution of specified entity. Three situations, three circumstances we consider a particular firm or a firm or AOP as reconstituted. One is retirement of a partner, admission of a partner, or there is no admission, there is no retirement, but all the partners or members continue with the change in the profit sharing ratio. So change in the profit sharing ratio can happen to all the partners or a few partners. It doesn't mean that all the partners' profit sharing ratio has to be changed. Even say there are 10 partners, there is a profit sharing ratio only with respect to some 3 or 4 partners, that also amounts to reconstitution. On these situations, if there is any distribution of assets, this section will attract. Then self-generated goodwill and self-generated asset means these assets which have been generated without spending any amount. So it's on self-generated within the firm or AOP. Then comes 6712, earlier 45.5, compulsory acquisition of a capital asset. So transfer of capital asset by way of compulsory acquisition under any law or transfer the consideration for which is determined or ascertained by the central government or RBI, and compensation or consideration is enhanced or further enhanced. So this is a situation of 45.5, yesterday 45.5, now it is 67.12. Where there is a compulsory acquisition of an immovable property, or the immovable property, the consideration or compensation is ascertained by, determined or approved by central government or RBI. So the first instance, so this is a situation where year 1 the acquisition happens. So there may be compulsory acquisition of a property. Year 1 it will be acquired, then there is a transfer. But when once the property has been acquired, you cannot pay the capital gains tax. So compensation you may receive in a subsequent year. So when once the compulsory acquisition happens, as per the definition of transfer, you are supposed to pay capital gains tax. Since you don't have money, so there is an exception to the general rule that the tax year in which such compensation or other consideration or part thereof was first received. So the situation may be first year you will then be acquisition. You may receive the compensation in 3rd year or 4th year. So the first time when you receive the compensation, that year you have to compute the capital gains and then pay the capital gains tax. In case of enhanced compensation, when once you give compensation, you will not keep it. No? You will ask for enhanced compensation. So whenever you go for enhanced compensation, it also may take number of years. When once you get the first this thing, in which such amount is received, you may have to pay capital gains tax on that also. Then there may be final order. When once you appeal for the enhanced compensation, it may be in the court where there may be interim order or final order. So whenever interim order comes, you have to wait for the final order and you have to pay the tax. Then deduction in compensation. Sometimes you may go for additional, they may reduce the compensation. In those cases, you may have to recompute the capital gains tax which was done earlier, and if you have to pay the tax or you have to get the refund, you should get it. In case of enhanced compensation or based on the interim order, there is an enhanced compensation, cost of acquisition and cost of improvement will be nil, because first time only we would have claimed everything, cost of acquisition, cost of improvement. So subsequently you cannot claim that, and any interest received on compensation or enhanced compensation is charged to tax as income from other sources. And then once enhanced compensation comes, so many people who are the owners may not be alive, because it will take so many years. By the time their property has been acquired, they may die. So their legal heirs will be the persons who will be receiving the additional compensation. Even though the original owner is not there, they should pay the tax as legal representatives as capital gains. Then comes 45(5)(a), now it is 67(14) to 16, that is joint development agreement. Whenever there is a transfer of property through joint development agreement, how it has to be done. So it applies to individual or HF, 67(14). Transfer of land, building or both under a specific agreement. So there is a specific agreement to a developer. So whenever there is an agreement with a developer, the year when that development agreement has been registered, there is a transfer. But he may not have money to pay the capital gains tax. So you have to wait till some of the things that happen, so that at that particular point of time he has to pay the tax. Capital gains shall be charged to tax in the year in which they receive the completion certificate. So whenever this joint development property is there, you should tell your clients, whenever whoever is coming for JD, first thing it has to be registered. Otherwise, entire calculation will go for a toss. So only registered document comes under 67(14), plus they have to obtain completion certificate. Without that, many taxation will not start also. So whenever the year in which completion certificate for the whole or part of the project is issued by the competent authority, capital gains has to be paid by the landowner. What is the consideration? Full value of consideration is equal to stamp duty value on date of the CC of the share of such person, being land, building or both in the project. So whenever he gives for joint development, it may be only the land he may give, or land and building both he may give. So whatever his share, the partner, the landowner's share, whatever is there, on that date of CC, you should see the stamp duty valuation. That will be the consideration to be paid. Of course, when in the practical issues, I have got one or two problems. You will understand better there also. Plus consideration received in cash or check or draft or by any other mode, which is non-refundable. So whenever you receive, as a owner, receive certain compensation, which is non-refundable in nature. That's why it says consideration received. So which is non-refundable, that is also subject to taxation. Section 6750 talks about some of the definitions. This is a competent authority, and if you see here, specified agreement means a registered agreement. So it should be a registered agreement, compulsory. That is specified agreement. If it is not a registered agreement, this section will not apply. So other sections will apply. So it should be a registered agreement. So whenever you enter into a JDA, many of your clients wants to enter into a JDA, so two things you have to tell them, that JDA agreement should be registered. Second thing is, after completion they should get a CC, that is completion certificate. So anything if you want to add or subtract, you can tell.
What is the cost we reduce here?
Which
Full
cost?
value of consideration.
No, one second. This one, whatever I said, two things. Anything anybody has to add, is it correct or it has to be registered and CC has to be obtained. Correct na? Correct sir? Anything you want to add or delete from whatever I said? Nothing. Okay. Yes. Yeah.
The full value of consideration minus the cost of completion land or
And that we will come. I have got an example there. We will. I will explain to you that.
The landowner is other than individual or actually?
Other than individual headship, it's not applicable here. This specifically it says individual headship. Other than individual headship, this particular section is not applicable. Okay. Now moving forward in the same thing, 6716 says when there is a joint development agreement and an owner has given his property for joint development and he has got his share. Say for example, he has given his plot of land where around 10 houses will be constructed. Owner's share may be 5, developer's share may be 5, for example, easy understanding. So he has to pay the capital gains tax when the year in which or the date on which CC is obtained. So year 1 he gives the land, year 3 construction is completed, he will get the CC, where on that year, for that tax year, he has to pay the capital gains tax. So he has got 5 residential houses for him. What he says, he has to wait till that particular point of time. But in between, if he starts selling the property before obtaining the CC, 67 section 16 will apply. So individual HF transfers of his share in the project on or before date of issue of completion certificate to any person. The capital gain shall be deemed to be income of the tax year of such transfer. Then full value of consideration is equal to the provisions of this act other than subsection 14. So subsection 14, whatever it discussed, that will not be applicable in this case. So if a person sells any property before obtaining CC, 6714 provisions will not be applicable. Other provisions of the act will be applicable, like 50C, 50D, whatever you have to take, that has to be considered. Other provisions like 72(1) is a combination provision where you have to take what is the consideration, less expenses, less cost of operation, all those things you should take. The 78, the immovable property valuation, that is stamp duty valuation, you have to take. And if you can't ascertain the actual consideration, 50D earlier, now section 80, fair market value of the asset that has been transferred has to be considered. So 6714 provisions will not be applicable in those cases where a portion of the share of the owner is transferred before the date of obtaining CC. Then 6717 is 45(6), repurchase of mutual fund units referred to in section 80 CCB2. I think of late we are not seeing practically any of these things. I have not come across any repurchase. Repurchase price minus actual cost will be the capital gains tax. Then distribution of assets by companies in liquidation. I think there is no change in 46 and 68. In case of distribution of assets by a company in liquidation, company will not pay the capital gains tax. It is a shareholder who is going to pay the capital gains tax. The computation is money received, the actual money received in case of distribution of assets, plus if assets are being given, fair market value of the assets. So money plus fair market value of the assets distributed to the shareholders minus deemed income under section 240C, earlier 222C. What is this deemed profit under 240C is the accumulated profit will be there. So whenever the liquidation happens, in the balance sheet you may have the capital, share capital and also accumulated profit. To the extent of accumulated profit, you have to reduce from this. The balance will be charged to tax in hands of the shareholder as capital gains. The accumulated profit which he receives is charged as dividend. Under 222C, now it is 240C. That will be considered as dividend. The balance will be considered as capital gains. This is 68, earlier 46. Then comes the repurchase of buyback of shares or other specified securities, 46A, now it is 69. Shareholders receives consideration from a company for purchase of its own shares or other specified securities. The chargeability will be the year of purchase by the company and the amount received, the buyback consideration minus cost of acquisition. So whatever the consideration they get minus the cost of acquisition, of course, depending upon the holding period, whether short term, long term, all those things you can see. If company, now there is an amendment here. So 69(1) and 46A was same. Now 16(2) has been added, which was not there in 46A. So if you see that if company purchases from shareholder or holder of specified securities who is a promoter, ordinary shareholders, whatever is there, the top portion will be there. If it is purchasing from a promoter, apart from whatever is there in the top, they have to pay additional income tax. So if the promoter is selling the shares in the scheme of buyback of shares, he has to pay the additional tax. And if promoter is a domestic company, and if it is a short-term capital gains, he has to pay additional tax of 2%. And if it is long-term capital gains, he has to pay additional tax of 9.5%. If the promoter is other than a domestic company, he has to pay 10% and 17.5%. What is the tax rate for capital gains, short-term capital gains? 20%. Long-term capital gains? 12%. So, in case of company, if you see promoter is a domestic company, 20% plus 2% comes to 22%. So, that is the tax rate for companies. Long-term capital gains, 12.5 plus 9.5 comes to 22%. In case of other than domestic company, 12.5 plus 10%, sorry, 20 plus 10 comes to 30%. 30% is the rate for other than companies, the slab maximum rate. And 12.5% plus 17.5% comes to 30%. So they want to ensure that the promoters, if they are doing this buyback of shares, where they are influencing the companies to buy back the shares, at least they have to pay 22% or 30% tax. So it's not they will go away with the 12.5% or 20% tax. So this has been added so that they pay minimum of 22% or 30% tax. So meaning of promoter and specified securities have been given under section 69 subsection 3. Now moving on to the next item, that is capital asset. So we have 5 sections here. The definition of capital asset, short-term capital asset, short-term capital gain, long-term capital asset and long-term capital gain. Here also there is not much change from 1961 to 2025. So 222 says capital asset means this is an exclusive definition. So certain inclusive definition means you can add something. In exclusive definition means whatever the list is there, it's an exhaustive. You cannot add anything similar to that. So it's an exclusive definition. Capital asset means property of any kind. So property means it includes both the movable, immovable, tangible, intangible, all types of property held by an assessee. It should be held by an assessee, whether or not used in a business or profession. And B, any securities held by FIIs and any investment fund. So all these FIIs and investment fund, whenever they hold these securities, it should be as per the regulations or approvals by the SEBI. Then any unit linked insurance policy, so for which exemption is not obtained. So ULIPs, there are certain ULIPs where exemptions are there. These are ULIPs where exemption is not there. So for all those things are considered as capital asset. But does not include the following. It will not include the following items. One is the stock in trade. So stock in trade used for the business is not considered as capital asset. Then personal effects. All the personal effects of assessee is not considered as capital asset except few things like if you see jewelry, archaeological collections, drawings, paintings, then sculptures or work of art. Even though it is considered as personal in nature, but it is considered as a capital asset. Then agricultural land in India, which is not in a specified area. If it is not in a specified area, it is a capital asset. If it is in a specified area, it is considered as a capital asset. What is a specified area? A municipality or corporation which is having population of more than 10,000. So if it is less than 10,000 and agricultural land is there, it is not a capital asset. If you have municipality or corporation which has got a population of more than 10,000, it is considered as a specified area. And if you have land in that, it will be considered a capital asset. Of course, there is something else. You have to, in any area within the distance, measured area. One is within the municipality or component, as a cantonment board. Then area measured aerially. Area measured aerially means it should not be a rail route or road route. So it's a like a bird flying or crow flying is what they say. So that is the distance they have to measure. So if the population is between 10,000 to 1 lakh, it should be within the 2 kilometers radius. More than 1 lakh and less than 10 lakhs, 6 kilometers. More than 10 lakhs, 8 kilometers. Today you get all these things in the, what do you call, when you put it into the system, you say which is the nearest municipality or corporation, all those things you get in the system itself. But one thing you should be very careful. You should not just see 2 kilometers. So there may be a situation where you will see something which is outside 2 kilometers. You see one cantonment board where the population is say 90,000. Your land may be 3 kilometers away from that. You will say that it is not a capital asset. But there may be a situation which is that may be within 8 kilometers of another municipality which has got population of more than 10 lakhs. So you should be very careful. Not one way you should not see and keep quiet. So surround entire thing you should see. Up to 8 kilometers any other things is there you should see. Then only you should decide whether it is a capital asset or not a capital asset. So 2 kilometers ಆಚೆ ಬಿಡಪ್ಪ ಇದು capital asset ಅಲ್ಲ ಅಂದ್ಬಿಟ್ರೆ ಆಗಲ್ಲ. Yes sir.
So the distance parameter is with regard to the periphery of that.
Yeah, correct. I can't tell you the periphery of Bangalore, sir. It is extending, expanding day in and day out. When every minister comes, it is expanding. So there I think something should be done. Because we don't know what is Bangalore today. Even though I am here from my birth, I don't know what is Bangalore. Every day new definition comes for Bangalore. So we don't know where we should go. Like that, surround the municipalities, correct. Whatever the boundaries are, whatever boundary, from there 2 kilometers. Or I don't know whether they measure from the center or something like that. Technicality I don't know. Maybe from the end only you can go for 2 kilometers. So what I am saying is don't just restrict to 2 kilometers, 6 kilometers, you test everything. So some place there may be 8 kilometers, you have a municipality having 12 lakhs population, you would have forgotten that. You wouldn't have seen that. So everything better to check.
Even in case of sub-registrar office, they are insisting TDS on agricultural property. By default, buyer is deducting. Nursing ups are asking, we are deducting TDS on agricultural property. It is not agricultural property, it is urban land like that.
Their checklist is different, sir. For many things you don't require 15 CB, but they will insist. You issue certificate, raise a UD, raise the bill also, collect the amount. Whatever you go and tell the bankers, they will not understand because they have got a checklist. Invoice is there, 15 C is there, 15 CB is there, that's all. Otherwise they will not release the money. So like that, I don't know which sub-registrar is asking. And they may not be having the list whether it is agricultural land, not agricultural land and all. If TDS has to be done, you can file the return and claim the refund. Very few cases I think it will come, not all cases.
Sir, importance of TCLR certificate. Importance of TCLR certificate in this will that will play a role.
Which one, sir? Which one?
Tahsildar certificate.
Tahsildar certificate. Tahsildar certificate will say whether it is agricultural land or not. But as for the income tax act, whether it is a capital asset or not, he may not say, no?
But who will be the particular person where we can approach and get the details saying that it is a urban agricultural land or
rural agriculture. Whether it is a capital asset or not capital asset.
Yes.
Normally in the schedule it will be there.
It will be there, huh?
Otherwise sub-registrar will be a problem.
Oh.
Normally it will be there.
So who is the authority to decide the distance?
Sir?
Who is the authority to decide the distance?
Yes, sir. I think I forgot a movie, Kannada movie actor, but that is, I don't remember the name, but that's a real story it seems. It was somewhere in northeast. One hill was there. Hill is there. Now there's a road has happened. So one village will be there. So to go to that other side of the village, they have to cross almost 40-50 kilometers. So when family wife gets very ill, that husband cannot take her to the hospital. She dies. So he gets angry with that hill and he will destroy the hill. Now the road has Maji. So now distance is just 2 kilometers. He has destroyed the entire hill. It's a real story. Maji, what is his name? Maji.
Dasharat Maji.
Okay. So he has cut the hills And now entire village can go to the other place within 2 or 3 kilometers. Where they were supposed to go around, like if you go to Bangalore to Chennai, you have to go around like this. Otherwise it will be 2.5 hours you can go. From Bangalore to Chennai, it will take 5 hours. Somewhere to accommodate some station, we have to go like this. If you see the route of Chennai train, actually we can go in 2.5 3 hours. Vande Bharat can go into 3 hours. But it will go like this and it will go like this.
It's like a Sagar, Shimaga, sir, with land.
So the aerial distance is what you have to see. The nearest distance, like LTC will take the nearest shortest road.
But it is practically challenging. Who has to decide? Like,
Now Google will do. Means you Google auntie will tell. If she tells correctly, it's okay. Otherwise, I don't know.
But the department considers.
No, madam, like as somebody was telling, you will have certain documents, madam. It's not that nothing will be available because entire sketch is available. Entire India sketch is available. It's not that nothing is there.
IT wise referring to CPW.
Somewhere you will get it. Some document will be there. So entire survey would have done and you may get that. But as I said, you should not see the rail route or road route or something like that. The aerial route is what they say.
So we got a notice from department to prove that it is an agricultural matter. At that time, whether we need to do all this exercise?
Whatever nursing officer asks, it's our duty to provide all that. He will not do it. He will issue the notice and keep it. That's all. Other things we have to do.
But somehow we made him understand.
Oh. Somehow. Sir, it is so in me, sir. It is so in me now. Okay, so of course, officers also will understand if you provide all the documents, not that difficult, but we should have proper documentation.
It's a bit challenging.
Yeah, challenging. Then some of the gold deposit bonds and deposit certificate. Now nobody will say gold is not a capital asset. Earlier also they are not saying, now nobody can say gold, silver, whatever it is, it's not a capital asset. Then short-term capital asset means a capital asset held by an SOE for not more than 24 months. See, in fact, here I thought 2025 would have done some changes. For the entire capital gains sections, if you read, it mentions about year. Whatever exemptions clauses, wherever you go, it talks about more than 2 years, more than 3 years, more than 1 year. But this they have retained as 24 months and 12 months. But this month is not a period of 30 days. It's not a period of 30 days. If I say 12 months, you cannot calculate 12 into 30, 360 days. It is still 365 days only. So it's 1 year only. So this they could have changed, but somehow they missed it. They have kept 24 months and 12 months only in section 211. In entire capital gains 67 to 91, if you see, there is no question of months at all. Everywhere they have mentioned about years. 2 years, 3 years, something like that. So this also they would have made 2 years and 1 year. So the basic rule is any capital asset held by an SSC for not more than 24 months, that is less than 2 years, it is considered as a short term. More than 2 years, it will be long term. But there are certain exceptions to this rule. The type of capital asset is securities listed in recognized stock exchange or units of unit trust of India, unit of equity oriented fund or zero coupon bond. If it is held for less than 12 months, immediately preceding the date of transfer. So whatever the time determination is from the date of transfer. So whatever under capital gains, wherever you determine the time, it will be from the date of transfer. So if it is held for less than 12 months or less than 1 year, it will be considered as short term. More than 1 year, it will be considered as long term in these cases. In any other asset, it is 24 months. There is one more exception for this, I'll tell later, which is beyond 12 months and 24 months. Only 1 year, one place is there, which goes beyond 24 months also. That has also not been changed. When 24 months has been changed, that is still remaining as more than 24 months, I will tell that. So this is the short-term capital asset and this short-term capital asset. So some of the cases they are given, how to determine the short-term time limit. Yeah, 5 ನಿಮಿಷ ಎಷ್ಟು ಬಂದಿಲ್ಲ Break. So some of the, how to determine the time limit, this 24 months, 12 months, some of the circumstances are given, some 20 situations are there. Say in case of liquidation of a company I was mentioning, where the company distributes the asset, the period post liquidation should not be considered for determining the period of holding. And wherever you have shares in the Indian amalgamated company, or say there is some business reorganization from amalgamation company to amalgamated company, you would have got shares in the amalgamated company. Okay, so that may be the shares in the amalgamating company. So to see the period of holding, you should go from amalgamating company. Similarly, demerger company in the hands of, in a case of resulting company. So like that, there are certain things where there is certain reorganization. Conversion of preference shares into equity shares. So there may be a situation where you would have received preference shares, converted into equity shares, and then you are selling it. So period of holding should be from the date of purchasing the preference shares, not from the date of conversion. Then now gold converted to ECR, electronic gold receipt, or electronic gold receipt converted to gold. All those things from the original date we have to mention. And a capital asset being a unit or units in a segregated portfolio. In case of bonus shares, you will get bonus shares because you are having a original shares. So for bonus shares, the date of period of holding should be from the date of allotment, not from the date of allotment of the original shares. Similar to that is right shares. So you may get right shares also. The same thing, the date of allotment. Sometimes you get you may get a right as a shareholder. You will not subscribe. You will renunciate that right to some other person, and they will subscribe and they will get the rights shares for them also from the date of allotment. When you transfer this right from one person to another person, that is a capital asset. So I am a shareholder. I am getting a right shares. I am not subscribing. I am giving it to someone else. So that transferring my right is a capital asset. So capital gain should come. For that, so date of acquisition will be the date when I get the right thing. When I am eligible to subscribe for the right shares, that will be the date of that particular asset. When I transfer to someone else, the period you have to see and pay the capital gains. For that person, from the date of allotment. And in case of security or sweat equity shares, which now we talk about ESOPs and the thing which will be employees will be receiving, the date of holding will start from the date when they exercise the stock options. When they pay the perquisite taxation for that, the date of exercising that stock option, from that date it will be considered as the period of holding. So this is short-term capital gain, means capital gain arising from the transfer of a short-term capital asset. So it only says short-term capital asset is 102, 101. 102 is short-term capital gain. Any profits or gains arising from the transfer of a short-term capital asset is short-term capital gain. Long-term capital asset means which is not a short-term capital asset. So they have defined only short-term capital asset. So long-term capital asset means which is not a short-term capital asset. Long-term capital gain means any profits or gains arising from the transfer of a long-term capital asset. Now we understood this 24 months, 12 months and all. Now there are certain exceptions to the general rule. One is section 74, depreciable assets. So depreciable assets, irrespective of the period of holding, it is considered as short-term capital assets. Short-term capital gains. So any amount received from the transfer of depreciable assets is considered as short-term capital gain. Then section 76, market-linked debentures and specified mutual fund, where irrespective of the period of holding, it is considered as short-term capital assets. So even if you hold it for 12 months, 24 months, 36 months or 60 months also, it is considered as short-term capital asset. 74, it is considered as short-term capital gain. In 76, it is considered as short-term capital asset. I will tell you why I am saying all this. I will tell you when the practical issue comes. Then section 77, slump sale. In case of section 77 slump sale, usually it is considered as long-term capital asset. Of course, there is one exception for that. Usually it will be considered as long-term capital asset irrespective of the period of holding. And in slump sale, it is not asset-wise you will calculate the holding period. It is based on the business undertaking or the division which is going to sell. That is a slump sale. Now this is a list I have prepared. Some of the capital assets. If you hold for less than 12 months, it will become short term. If you hold for more than 12 months, it will become long term. So like listed equity shares, units of equity oriented fund or units of UTI, zero coupon bond, listed units of business trust, listed bonds, listed debentures, other listed units, gold or silver. So all these things, most of it are listed and equity oriented fund and units of unit trust of India and zero coupon bond should be held for less than 12 months. It will be a short term, more than 12 months it will be long term. Then we have other assets like unlisted shares, private company shares and foreign shares and foreign ESOPs. So here we should be careful. You may get ESOPs, most of your clients will get ESOPs and foreign company shares they get. It is listed in a foreign country. So listed, when we say, should be listed in the recognized stock exchange in India. So there may be listed in NASDAQ also. They may get as ESOPs, but it is considered as unlisted shares. There you cannot apply this 12 months rule, you have to apply 24 months rule. Land or building or both 24 months. Unlisted bonds, debentures, unlisted units, specified mutual fund, that is debt mutual fund and money market instruments acquired before 1/4/2023. So this date is also important. Acquired before 1/4/2023. And TDR, transferable development rights. So where in some of the cases you get TDR instead of compensation for compulsory acquisition. That is also considered as a right, not as a building or land. So that's also 24 months. Jewelry, archaeological collections, everything less than 24 months. So this is one more exception. I said slump sale. It says if the unit or division is held for less than 36 months, it will be considered as short term. More than 36 months is considered as a long term. So 12/24, this is the 36-month criteria. And we have these things, unlisted bonds, debentures, MTR on or after 23/7/2024. I will tell you what is MTR afterwards. We will go for coffee. After 23/7/2024 is considered as short term. There is no question of long term. So I am not put, you need not see 12 months, 12 months, everything. It is a short term capital asset. Then market linked debentures, short term. Specified mutual fund, that is most of it are the debt funds, acquired on or after 1st of April 2023, it is considered as short term capital asset. So there is no question of applying this holding period, 12 months, 13 months, it is whatever the period you hold, it is a short term capital asset.
Property purchased and given on JD immediately, how will you consider it? Example.
It is there. That also I have covered in that. I will. So it should be there till 8 o'clock. Break, Manu. Oh. So we'll go for a break and come back after a break. This time. So during the break, how many of you ate 3 dosas? Only one. Okay. Only I ate 3 dosas because I gave some correct answers. But still, few people ate 3 dosas. Okay, no problem. Now many questions came. Madam was asking how to remember the sections. She was worried. The new sections, how to remember. So how to make what you call how we should remember, how our clients will remember. She was very much worried. See, because we are as South Indians, we are change makers, right? You agree? We are change makers. We change the government itself. All the 5 states we have changed the governments. So we are change makers. We should not be afraid of change. And change keeps coming. So when most of our seniors who have completed or with me when we did our CA, there is no GST, there is no Companies Act 2013. So we have been studying 1961 Act from 1961. So the change is inevitable and we are capable of accepting the changes. This is one more change. Definitely we can embrace this change. As I said earlier, it's an opportunity. I should thank FM for giving me to come and speak here. That is one aspect. For all of us to open the Income Tax Act once again so that we can read through that. And basic is something which every one of us should keep doing once in 2-3 years, whichever activities. Whatever we are supposed to do, the basics, we assume that we know everything because we are chartered accountants. And once you open one section, you understand. So it's always better to go back to the basics and keep reading. So this is one great opportunity where you can go through many things. And many more questions were there during my lunch break, sorry, tea break. Still I am in capital asset, transfer, computation, so many things have come. I said we will discuss one by one during the course of this thing. So capital asset we have completed and chargeability we have completed. Now the next aspect is transfer. 3 sections are there. One is the definition section 2109, earlier 247. Then transactions not regarded as transfer and withdrawal of exemption in certain cases, 70 and 71. Now if you see the definition of transfer, it's an inclusive definition. So earlier capital asset definition was an exclusive definition. It means now it is an inclusive definition. So similar to these type of transactions will also considered as transfer. So whatever we list down here, if something is there similar to that also will be considered as a transfer. There is no change from 1961 definition to 2025 definition except the section number. Earlier it was 247, now it is 2109. So what are the things that covers transfer? Sale, exchange or relinquishment of any asset, extinguishment of any rights therein, then conversion of capital asset into stock in trade, then we have maturity of zero coupon bond, compulsory acquisition of any land, then we have any transaction that is joint development agreement, we were telling now. Like whenever there is a joint development agreement or an arrangement where you are allowing the possession of a property. One person is allowing a possession of an immovable property through this joint development agreement or any other arrangement, that is also considered as transfer. Then we have a transaction allowing the possession of a particular property under part performance of a contract under section 53A, that is also considered as transfer. Then indirect transfers. So earlier we had this indirect transfers, which was, you can see this Vodafone case where it was decided against the revenue. Then they brought in this particular section, indirect transfers. It was there as a, or you say this, proviso. In 247 it was like a proviso, second proviso 247. Now it has come as a separate sub-clause there. All the indirect transfers is also considered as transfer. And one more thing is there where if you become a member of a cooperative society or a company, you will be entitled for a property. So these type of things, it's not common in Bangalore. This is common in Mumbai or Calcutta or Delhi, where the entire property is considered as a cooperative society or association of persons or a company. Say suppose there is a 100 units in a particular complex, they will convert as a AOP or something like that. So each building will have a membership. So if I become a member of that particular cooperative society, I will get one plot. So there will be a membership for 100 houses. Or it may be in the form of a company where I will be a shareholder. So if I get one share, I will be eligible for one house property. So subsequently when I have to sell, I will not sell the property, I will sell the share. So in this thing, the property will be transferred. So those things also is considered as transfer. And they have also defined the immovable property under 2109. Now comes this situation. I will stand here because it's recorded here. AC is not working anyway, no problem. So section 70 talks about situations where it is a transfer but not regarded as transfer. Around 38 situations are there, and under section 70 they have defined some 38 situations where there will be transfer of capital asset but it is not considered as transfer. So some of the situations like, I will not read out the entire thing, but some of the situations like when you get an asset from a previous owner in the form of gift or under a will or irrevocable trust, that is not considered as transfer. So when once you receive that particular thing, it is not considered as transfer, but subsequently in the transfer, that is considered as transfer. Or there may be a situation of an HF where partial or full partition of an HF happens. All the assets of the HF will be distributed among the co-partners and Cotha of HF. That is also not considered as transfer. Then there may be certain transactions where there is a transfer of assets from subsidiary company to holding company or holding company to subsidiary company. The recipient company should be a Indian company, and it should not be in the form of stock in trade. It's only a capital asset, and it should be a 100% subsidiary company. There are certain conditions in these two cases where assets are transferred from holding company to subsidiary company or subsidiary company to holding company. They should be 100% subsidiary company, and they should not convert this particular capital assets into stock in trade for the next 8 years. Both the next 8 years, they should be 100% holding, and they should not convert this capital asset into stock in trade. So initially when they transfer, it is not considered as transfer. And there are many business reorganization. There may be amalgamation of companies, demerger of companies, like cooperative society merging with another cooperative society, banking companies, or mutual funds. There will be integration, or some specific funds they will be integrated. So in case of amalgamation or demerger, if you see, assets from amalgamating company will be transferred to amalgamated company. That is one transfer, not considered as transfer. At the same time, shareholders of amalgamating company will get the shares of amalgamated company. So they will give away these shares, they will get that shares. So that is also not considered as transfer. So like that, there are so many situations with respect to business reorganizations. We have three succession situations. Succession situation means where a proprietorship concern is succeeded by a company, or a firm is succeeded by a company, or LLP takes over private limited company or unlisted public company. Public company. In those cases also, it is not considered as transfer, subject to certain conditions. So there are certain conditions in those sections. If you maintain that, if you fulfill that, it is not considered as transfer. And there are certain situations where there is a transfer of certain assets like GDRs, bonds, rupee denominated bond or other assets from non-resident to non-resident outside India. So that is also not considered as transfer, and there are certain things where it has been done in IFSC, in the recognized stock exchange in India, where it is in IFSC center and the transactions happen through foreign currency. Those things are also not considered as transfer. Then there may be conversions like preference shares converted into equity shares, or debenture stock converted into debentures or shares of a company, or gold converted to electronic gold receipt, or electronic gold receipt converted to gold. So all those conversions also are not considered as transfer. And some of the other things, if I have to mention, one is reverse mortgage. In case of senior citizens, there is something called a reverse mortgage, where they can give their immovable property to the bank and they can borrow some loans. So they will not repay that particular loan. At the death of that particular person, the bankers will realize that particular, sell that particular property. Whatever they are supposed to get from them, they will get it. Balance they will transfer it to the legal heirs. So like that, there are certain things. Like earlier it was all, the stock exchanges were all in the form of association of persons. Now it has become a corporatization form. So there was conversion. So there were equity shareholders or equity in that erstwhile stock exchanges, which was not in the corporatization form or demutualization form. So there also they will get the shares in the corporatized form. Now we have Bangalore Stock Exchange Private Limited. Earlier it was not Bangalore Stock Exchange Private Limited, so only a group of people as Bangalore Stock Exchange. So when once it became corporatized, so all the members of that, they got a shares in this, and there was, one is members, one is trading rates they had. They also got the members shares in the new formed company as such. There also, for exchange of their membership and getting shares, it will not be considered as transfer. So like this, around 38 types of transfers are there. I have just made a list of all those things. What is the asset transfer, from whom you will receive. Maybe when once you go through this, clearly you will understand. Further, if you want to understand, section 7. Then if somebody is having these personal assets, like they may have archaeological collections, sculptures or paintings, drawings, if they want to donate it to some national museums, so that is also not considered as transfer. So in some of the cases, it will go out of them, like the transfers, it will go out of them, but some of the cases it will come to them, subsequent transfer will be considered as transfer. So it doesn't mean that subsequently it is not considered as transfer. Say suppose I get a gift from my parents, that is not considered as transfer, as inheritance or gift. Subsequently, when I sell this particular property or that capital asset, that will be transferred. So this is section 70. And section 71 says withdrawal of capital exemption. It talks about 71C and 71D, that is transfer of assets from subsidiary company to holding company to subsidiary company, 71C. Subsidiary company to holding company, 71D situation, where they transfer the capital assets. The condition is next 8 years it should not be converted into stock in trade, or the 100% holding should not be reduced. So any year any of the things happens, whatever the exemptions that they have given that is not considered as transfer will be charged to tax. Then the next two is this succession, where a proprietary firm or partnership firm is succeeded by a company. In those cases there are certain conditions. Either the partners or proprietor, they have to get the shares in the company and they should take minimum 50%. They should hold more than 50% for next 5 years. And they should not get anything except the shares in the company to the extent of the capital. So in case of partners, all the partners will become shareholders, they will get it. In case of proprietor, along with him he should get 1 or 2 more persons. So his holding should not be less than 50% for next 5 years. So if any of those conditions are not fulfilled in the next 5 years, the exemption given will be revoked. Similar to that is whenever this company is succeeded by LLP. So same things are there. So that the conditions, if we read, any violation of those conditions, it will be charged to tax in the year where the violation happens. Now we will come to the main aspect, one of the main aspect of computation. These are the sections which deal with the computation, which is most important for all of us. Section 72 to 80. Then we have discussed 196, 197, 198. That is 111A, 112 and 112A of the 1969. Yes, sir.
Transfer of loan property from individual to family directors, does it come into 105 or 70?
Individual to family trust. It's an irrevocable trust, means it will come, sir. We have to see. Irrevocable trust, we have to see. Revocable trust may not come. Irrevocable trust, we have to see, may come there. By person to irrevocable trust, it will come. It should not be a revocable trust. Then there may not be, it may not be covering if it is a revocable trust. Only if it is an irrevocable trust, it will come. So these are the computation methods. We cannot leave anything in this, I suppose. So we have to go through everything. So section 72, earlier 48 is a computation method. So all of us are aware, this is the computation for short-term capital asset and this is the computation of long-term capital asset. Gross sale consideration less expenses incurred only and exclusively with respect to the transfer. You will get the net sale consideration. From there we have to deduct cost of acquisition and cost of improvement. Then you will get capital gains before claiming any exemptions. In case of short-term capital asset, exemptions can be claimed under section 83, 84, 87 and 88. In case of long-term capital asset, all the 7, 82, 83, 84, 85, 86, 87, 88. Now, in case of long-term, earlier we used to substitute cost of acquisition and cost of improvement to index cost of acquisition, index cost of improvement. Now, as all of us are aware, this indexation is not available except only 1 or 2 instances or circumstances. Otherwise, there is no concept of index cost of acquisition and index cost of improvement anymore. Same thing continues in 2025 Act also. Now section 72(1), that's what I said, whatever the income chargeable, you can claim the deductions, that is expenses incurred only and exclusively with respect to the transfer and cost of acquisition and cost of improvement. 72(1) says from the gross receipts, total sale consideration, gross sale consideration, you can claim these 2 deductions. Then 72(2) says for the purpose of item B of formula in section 197(3), the words cost of acquisition, cost of improvement can be substituted as index cost of acquisition and index cost of improvement. Should I wait till I go to 197(3) or should I tell now itself?
Now it's
Okay. So 197.3 is earlier 112. So whenever there is a transfer of capital asset, being land or building or both, which was acquired before 23 July 2024, but transferred after 23 July 2024 in respect of individual or HF. This applies only in the case of individual or HF, where they have acquired this land or building or both before 23rd of July 2024 and transfers after 23/7/2024. In those cases, in 1961 Act and the same thing in 2020 Act also, but in 1961 Act they gave the explanation in the form of a paragraph. In 2020 Act they are given a formula. But that I will tell when 197 comes. This is where if an individual HF has acquired a land or building or both before 23/7 and transfers after 23/7/2024, after 23/7/2024 there is no indexation. So whenever there is a transfer of land or building, you have to take the gross sale consideration less expenses, net sale consideration, less cost of acquisition, less cost of improvement, capital gains, whatever exemptions if you are claiming. The taxable capital gains is charged to tax at the rate of 12.5%. This is the computation mechanism. So you cannot put indexation. But in case of individual and HF, they are given this particular thing where all these conditions are fulfilled. You can calculate under the old Act, putting what do you call this, index cost of acquisition, index cost of improvement, and whatever capital gains comes, you have to charge the tax at the rate of 20%. Now 12.5% is some amount, 20% is the other amount. If this is more, that is 12.5% is more, the excess can be ignored. The example is that you will understand clearly if you are not understood. So say suppose under 12.5 the capital gains tax comes to 10 lakhs, under 20% it comes to 8 lakhs. So this is more, 10 lakhs is more. 10 lakhs minus 8 lakhs is 2 lakhs, you can ignore. That is, whichever is less you can take. Whichever is less you can take. So if this is 10 lakhs, this is 11 lakhs, you can still stick on to 12.5%. But finally, the taxation will be 12.5% tax. Okay, so that's what 197.3, 72.3 says. For those cases, instead of cost of acquisition, cost of improvement, you substitute the index cost of acquisition. 72.3 says following are not allowed as deduction. See earlier I have computed one thing where a particular assessee has purchased a property. This is under construction. So he has subscribed for a flat. So it is under construction. Nowadays, if you take a very big project, it may take 3 to 4 years. So they will show that sky and say your house will come there. 10th floor, 11th floor. See that crow is flowing. There comes your house. They will say. We will also say, okay, that is my house or something that I will buy. So year one I will buy. The construction keeps on going. It may take 4 or 5 years. Third year I may sell the property. For purchasing that particular right, I would have borrowed some amount and I will be paying interest. So whenever I sell that in the third year or fourth year, whatever the interest I pay every year, that interest on loan, I have claimed it as cost of improvement. Because after that, at that time it was more than 36 months, it would have become long-term capital asset. So there, or even short-term, you can claim the cost of improvement. So whatever the interest you pay every year, because you cannot claim the interest as income from house property until house property is there. The principal you can claim under ETC, but interest on house property, you cannot claim the exemption because you have to offer that income from house property. Then only you can claim interest on house property, housing loan. Till that time you cannot claim. So in this case, whatever the interest we used to pay there, we used to take it as cost of improvement, and whatever the indexation we used to claim. Now this few people would have, even after claiming interest under 24B, maybe they would have claimed as cost of improvement. So now they have brought in this clause where if you have claimed interest on housing loan under 24B S12, now it is 22B, or under any other provisions, again you cannot claim it as a cost of improvement. This is with respect to, in case of unit holders of business trust, this requires more detailed study. It's for homework for all of you. So in case of business trust, see, one thing I would like to say in case of business trust and unit holders, whatever is taxable, see, whatever the income you determine in the hands of business trust, the same thing will be determined in the hands of unit holders. Say if in the hands of business trust it is business capital gains, it will be capital gains in the hands of unit holders. If it is income from other sources, it will be income from other sources here also. The next thing is, whatever is taxable in the business trust will be exempted in the unit holders. Whatever is exempted in the business trust will be taxable in the unit holders. That much only I can tell now. Then 72(5). Okay. In case of specified asset received by specified asset, what is the computation? Like 67(10) we were discussing, right? That the same thing. So here, my value of money or capital asset which has been received by a specified person from a specified entity, deemed as income. In computing capital gains, you can claim the deduction under section 72(1). That is what the expenses claimed, cost of acquisition is, the capital balance, all those things you can claim. Plus deduction under section 72(5). 72(5), this is 72(5), it gives some attribution. There is a rule 50 which says whatever assets left in the hands of a specified entity, to that extent some attribution has to be done. Again, that is a big exercise, rule 50, you have to go through that. So what I can tell at this point of time is, apart from 72(1) deduction, we may have to calculate 72(5) deduction also in case of these transfers. So specified entity will get one more deduction. So whatever the assets they are carrying, something they are distributing, something they are carrying, so that proportionate deduction the specified entity will get, and balance amount only they will pay the capital gains tax. So then they have to file form 27 showing all the calculations done as per section, as per rule 50. So this is mode of computation of capital gains in case of non-residents. Somebody was asking residents, this is non-residents. So non-residents buy Indian shares by paying in foreign currency. It's not Indian currency. So non-residents buying shares of Indian company by using foreign currency. So when they purchase, they will use a foreign currency. When they sell, what is the computation? So it was earlier, I think, explanation 2 to section 48 or 1A or something like that. Now it is a separate subsection. We know all these provisos, explanation, everything now has become a subsection in the Income Tax Act 2025. So when you purchase Indian shares using foreign currency, when you sell that, so you have to convert that. So convert into that foreign currency, and you have to, what you have to convert? The full value of consideration, then the cost of acquisition and expense incurred. Whatever you incur in the Indian rupees, you convert into that foreign currency, and you will arrive at the capital gains in the foreign currency. That again you have to reconvert into Indian currency. Okay, so now a non-resident has acquired certain Indian company shares using foreign currency. Now he wants to transfer that. So you take the full value of consideration in Indian rupees, cost of acquisition in Indian rupees, expenses incurred in Indian rupees. That you convert into that particular foreign currency and the rate of transfer. So everything, and you arrive at the capital gains in foreign currency. Again that you reconvert it into Indian rupees and charge the capital gains on that. So this applies for every subsequent purchase. Like 1 second, sir. So now initially he has purchased some shares, you have converted that, he has sold that particular thing, you did this exercise. Again you invest in another shares, again you sell, the same thing keeps continuing. Yes sir.
So even the cost of acquisition needs to be converted into a foreign
Currency, yes.
as on the date of...
Yeah, that we have to see the rules, sir. That rule, there it has given how it has to be converted. So as per the TT buying rate, SBI TT buying rate, selling rate and all will be there. Based on that you have to convert. And again reconvert. Anyone has done this? Practically? I have done once, that's why I'm asking. Long back I have done.
How do we determine,
So one of the,
how do we determine whether he is buying in foreign currency?
no, that you will know, okay, because it's a non-resident, you will know what is the source that he has been used. From NRE account or something like that you have taken. So that you can get it. Because it's not for resident, from non-resident. So the question in the break was residents buying companies outside India in foreign currency. For that, this is not there. What I told her is, whatever you receive credit to your bank account, you can take it as consideration. Because all those things, end of the day, the same thing comes. So if it is foreign assets, which has been purchased by Indian residents, how you will do for ESOPs? How you will do for ESOPs? It's also foreign this thing. Sometimes in foreign currency only they are purchased. So even though they are not purchasing foreign currency, the amount will be transferred from Indian rupee and they will purchase in foreign currency. So basically we do based on the bank account statement, what is outflow, what is inflow, based on that we take it. Then these are some of the definitions, 72.8, cost inflation index, index cost of acquisition, index cost of employment. Now most of it may not be, it has not changed and most of it is not relevant in the 2025 Act. Next comes section 73, cost with reference to certain modes of acquisition. In 101 we were discussing about period of holding. So this is cost with respect to certain modes of acquisition. Here also some 24 items are there, where the asset is acquired from a previous owner. So now I said a person is getting in the form of a gift, will or irrevocable trust. It is coming from the previous owner. So what should be the cost when I transfer? So cost to the previous owner plus any improvement by the previous owner or improvement from myself. So that cost to the previous owner is what you have to see in many cases. Some of the cases, like in case of demergers, in case of demerged company, you will get the shares of the resulting company and also the demerged company. Sometimes you will get the shares of both the companies. In case of demerger, you will get the shares of demerged company and also the resulting company. How to value this cost of demerged company and resulting company? So there is a formula which has been given based on the assets transferred from demerged company to resulting company. It's not that demerged means entire assets will not be transferred. So portion of it will be transferred to the resulting company. So what is the portion that has been transferred? That will be the cost in case of resulting company. And in case of demerged company, the original cost minus cost arrived at the resulting company will be the cost for the demerged company shares. Like that, there may be certain consolidation of funds, mutual funds or some specific funds. In those cases also that formula will be used. Then in case of bonus shares, the cost is nil. In case of bonus shares, the cost is nil. In case of right shares, the amount you pay for subscribing that right shares, that will be the cost. In case you buy the right shares, by buying the rights renunciation, say as I said example, I got the rights, I am giving it to someone else, I will pay certain amount to get that rights this thing, plus I subscribe for the right shares. So in case of units or shares purchased on rights renunciation, the amount I pay for rights renunciation plus the amount I pay for the shares will be my cost. And when I sell the rights renunciation, my cost is nil because I have not paid anything. And in case of inventory converted into capital asset, fair market value on the date of conversion. And in case of ESOPs, I said when it will be subject to tax in the hands of employee on the day they exercise that particular ESOPs. So on the day they exercise the ESOP, that will be the fair market value. So subsequently when they sell, that will be the cost. So on the fair market value minus amount recovered, we will pay the what do you call this, perquisite taxation. So subsequently that will be the taxation, that will be the cost for them. And in case of some of the properties, immovable property and movable property transferred from one person to another person who is not a relative. So it used to be taxed in the under section 56(2)(10). Now it is 92M. So we will calculate that beyond 50,000 if you have received either for inadequate consideration or no consideration, that will be treated as income in the hands of recipient. So when once they sell that properties, the whatever the tax they have paid, that will be the cost for the subsequent sale. So whatever the amount on which they have paid the tax under 56(2)(10) earlier, 92M now, that will be the cost for the subsequent transfers. In case of trust where accredited income tax is paid, in case of trust in the situations where they are supposed to pay accredited income, you have to value the assets, fair market value on which you have to pay the accredited tax. Subsequently when you are transferring, whatever the amount you have paid, that will be your cost. Now section 74, special provision for computation of depreciable assets. In fact, I said one of the exception to that particular rule is section 74. So section 74(1) applies to capital assets which are depreciable and form part of a block of assets on which depreciation has been claimed. Overrides the definition of capital asset period as per section 2(101). Even long-term capital assets treated as short-term. Here we should also understand section 33, which talks about depreciation. 33 subsection 7 says, irrespective of whether an assessee claims depreciation or not, it is assumed that depreciation has been claimed. So when I was doing this particular profits and gains of business or profession, somebody asked me a question. There is a building used for the purpose of business, but I have not claimed depreciation for 3 or 4 years. Now I am selling the particular property, whether it is a long-term capital asset or short-term capital asset. What is that? Why short-term? So it is a depreciable asset. Irrespective of whether you claim the depreciation or not, it is considered as depreciable asset, and it should be computation should be under section 74, not under section 72. We cannot say that depreciation was not claimed, so I will take it as long-term or short-term based on the period of holding. Irrespective of whether you have claimed depreciation or not, section 33(7) says it is assumed and presumed that depreciation is allowed. So then again you should come to section 74. So there are two sections, two situations, section 74(2) and section 74(3). One situation is such that if you are selling a particular asset in a block of assets, so there may be multiple assets in a block of assets, you are selling one asset where the selling price of that particular asset exceeds the WDV of that particular block plus additions made during the year, the block will become negative. You understood? So there are multiple assets in a particular block. So I am selling one asset where its selling price is more than the opening WDV plus additions made during the year. So then there is a gain. The second situation, 74(3) says where you have a block of assets and all the assets in the block has been sold. So the block ceases to exist. In those cases, we are again selling price minus the opening WDV and additions during the year. So if you see the computation, what is the computation for capital gains? Sale consideration, less expenses, net sale consideration, less cost of acquisition, less cost of improvement, capital gains. For this 74 depreciable assets, net sale consideration is what the amount you receive. Less expenses if you have incurred, you will get net sale consideration. First one is gross sale consideration, expenses, net sale consideration. Cost of acquisition is WDV, opening WDV of that particular block. Cost of improvement is additions made during the year. So instead of cost of acquisition and cost of improvement, we will substitute opening WDV of that particular block and additions made to that particular block. So for example, under the situation of 74(2), where all the assets in the block is not being transferred, one asset has been transferred which exceeds this thing. So sale value of assets 5 lakhs, expenses 20,000, opening WDV 2 lakhs, additions during the 1 lakh, short term capital gains is 1,80,000. Okay. In the same example, instead of 5 lakhs, I will take 3 lakhs. Same consideration. What will happen? So there will be a loss of 20,000. Right. So if in under section 74(2) situation, there cannot be short term capital loss. Even if there is a loss, you cannot take it as short term capital loss. So I cannot say this is a short term capital loss and I will adjust against any other asset. So you have to close it to that extent. Whatever that opening WD, that's all you can do. The short term capital loss I cannot adjust or claim against any other things. Was that clear? Madam, your question. Or I have to say 74(3) also. So 74(3) is all the assets in the block has been sold. So here sale value more than the book value, profit is considered as short term capital gains. If sale value is less than book value, it is considered as loss and it is a short term capital loss. This can be adjusted against other income. So 74(2) situations you cannot take short term capital loss, only short term capital gains you can take. 74(3) situation you have to take only you can take both capital gains and capital loss. So this example here, 3 lakhs opening WDV, additions during there 1 lakh, total assets in block are sold for 3,50,000. All the assets have been sold in the particular block for 3,50,000. So if you see the computation here, sale consideration 3,50,000, expenses 0, net sale consideration 3,50,000, opening WDV of the block of assets 3 lakhs, additions is 1 lakh, 4 lakhs, short term capital loss is 50,000. So there is a short term capital loss of 50,000 which can be adjusted against any other income or whatever the future things you can take it in under 74(3) situation. Is that clear? Madam, you have any doubts in this? Or this is a different situation?
Yeah, different.
Yeah, tell me madam, we will also understand all that.
In that case, it is an individual asset which is having capital gain.
Individual asset, Next, there is a block or what is that?
It is just a building and it is a capital gain. As per section 41(2), to the extent of depreciation already claimed can be shown as business profit, and over and above the cost of the asset can be claimed as short-term capital gain. Is it valid for even normal manufacturing?
No, that is there for 3310 is there. Section 3310 is there. That is only for depreciation claimed under 33(2). That is for power generating units. What you are saying, power generating units where they claim depreciation on a straight line method, if that has been transferred, you can claim it as a deduction. So in this case, we have to observe, I think that may not be possible, or we have to see how it will happen. This is a 74(3) case, what you are saying. All the assets in the block has been transferred.
There were no asset actually.
That's what. It means the block ceased to exist. Only one asset you are saying, that is also all the assets in the block has been transferred. So there is a capital gain. Because of that, what she is saying, whatever depreciation we have claimed earlier, whether I can adjust from this gain as business income, balance I can take it as short-term capital gains is what she is asking. Correct?
As per section 41, subsection 2.
No, 41 subsection 2 talks about WDV value. But whether this can be adjusted against that, we have to see. But according to me, only 33 says, only in case of power generating units, it specifically says 3310. Here, it will not mention anything about that.
Yeah, that section did not mention anything specific about the power.
So here it says whatever the gain it comes, it should be considered as short-term capital gain. Any other point here, or if anybody has got a counter point on this?
So in this case, the loss cannot be set forward.
It can be taken. Here you can take. This is see the assets here, block cease to exist. 74(3) situation you can take it. 74(2) situation you cannot take it. You should stop at the profit. Means you should nullify that. You cannot take the loss. Here you can take it because that block continues. In the first situation, maybe next year there may be additions to that block. So again it will be rejuvenated, something like that. This is section 75 where it talks about power generating units, where they charge claim depletion on straight line method. Earlier we were talking about block of assets. What they say here also the same thing, this thing has to be applied. So you should not take the cross block. After the depreciated value you should take it. Next comes section 76. This is 50 AA. For computation of capital gains in case of market linked debentures. So MTR I was talking about. MTR means these units matures or transfers or redemption. Which are those assets? A unit of specified mutual fund acquired on or after 1st of April 2003. So this date is very important when this particular asset was acquired. If it was acquired before 1/4/2023, this section will not apply. After 1/4/2023, then market linked debentures, then an unlisted bond where this maturity transfer redemption happens after 23 July 2024. Here acquisition is not the criteria, the transfer is the criteria. So either it matures or redeems or transferred after 23rd of July 2024. The unlisted debentures or unlisted bond, then it is considered as short-term capital gains because it is considered as short-term capital asset. So all this situation it is considered as short-term capital asset. Any income arising out of that is a short-term capital gain. So the formula for computing short-term capital gains is equal to full value of the consideration due to transfer minus cost of acquisition of such capital asset minus expenditure incurred. Say whatever that formula we have, no? Cost of acquisition, sale consideration minus expenses minus cost of acquisition, that is what they have given in the form of formula. No deductions will be allowed for any sum paid as security transaction tax. That is, as we know, because it is charged to tax under capital gains, so STT paid will not be allowed as a deduction. So 76(5) defines market linked debentures and specified mutual fund means a debt fund. So somebody was asking in the break, how do you ascertain whether it is a debt fund or a specified fund? Probably when you go and I think which site, if you go to that money control or something, if you just go there, if you put that, you can give what is the nature of that particular debt. Usually it's all debt funds. It says if you are investing more than 65% of the total proceeds in debt and money market instruments, or you are investing in a fund which invests more than 65% in the debt units. So it's all basically related to the debt instruments, debt funds. So if you are investing directly to the mutual fund, that mutual fund should invest more than 65% in debt, or if you are investing in a fund which invests in another fund of fund we call, that will invest more than 65% in debt funds. Next comes this lump sale, section 77. One or more undertakings or divisions have been transferred. So it's not that each and every asset will be transferred here. Either a division or the entire undertaking will be transferred. So section 77(2) says if the undertaking or division is held for less than 36 months, it is considered as a short term. Otherwise, it is a long term. Here we will not go and see each and every asset when it was acquired. So there may be a situation, the undertaking is for more than 36 months, an asset could have been purchased last month, but still it will become a long term capital asset. So you will not assign or start determining the holding of each and every asset. Its entire unit or entire undertaking has been transferred. So we have to see the period of that undertaking or the division. So in the year of transfer, it is considered as deemed income. Computation of capital gains in case of slump sale is given under section 77, subsection 3, where capital gains is full value of consideration, that is fair market value of capital asset, to be determined as per rule 53. That is, for every asset there is a rule where it has to be determined, how it has to be determined, minus cost of acquisition or cost of improvement. What is cost of acquisition and cost of improvement in this case? We know the formula. sale consideration, expenses, net sale consideration, less cost of acquisition, cost of improvement. In depreciable asset for cost of acquisition and cost of improvement, we substituted opening WDV and additions to material. Now in slump sale, what is that we have to consider? Substitute for cost of acquisition, cost of improvement, the net worth of the division or undertaking. So the net worth of the division or undertaking should be substituted for cost of acquisition and cost of improvement, which section 77.5 says how to arrive at the net worth of the division or undertaking. So every SSC in case of slum sale should furnish a report from an accountant, that is a practicing chartered accountant, in form number 28. That's what we saw, which is the form that has to be used. And it is rule 54 which gives the how it has to be taken, and it has to be by the date specified under section 63. It's not 63, I think it is 263. Under 263, 1 month before due date of filing the return of income. It is 263(1), where you are supposed to file the return of income. Earlier it was 139, now it is 263 subsection 1, the due date. 1 month prior to that means 30th of September. We have to furnish this particular form, and it shall include computation of net worth of undertaking or division and certify that net worth has been correctly arrived. So a chartered accountant has to certify the net worth of a particular undertaking, and he also has to certify whether that has been arrived properly. So 77.5, net worth is aggregate total value of assets minus value of liabilities in books of accounts. So in case of depreciable assets, they take written down value of the block of assets, and in case of goodwill, if it is self-acquired, which has not been acquired from the owner, it is nil. Capital assets, entire expenditure allowed as deduction under section 46. So section 46 is a specified business. Earlier 35 AD, now it is specialized business, specified business, where capital expenditure can be allowed as a deduction. Usually business allowance will be for revenue expenditure. This is a section where even capital expenditure can be allowed as a deduction. If you have already claimed the entire capital expenditure, the asset is still with the business, then the value will be nil. You cannot claim that. Then other assets, it will be book value. And here when I talk about depreciable assets, say suppose there is a land or building. So as I said, you will not assign individual value to each and every asset. It's a net worth which will be taken. But for the purpose of transfer of title, the ownership from one person to another person, you may have to pay the registration charges for immovable property. For that there is a value. You understood what I said? So there is a value for transferring the property. Stamp duty value is there, but when it comes to slum sale, you will not take that value for the depreciable asset. So we need not take that. That's only for transferring the ownership. So this is the computation. As I said, for what do you call this, cost of acquisition and cost of improvement, you have to substitute net worth of the undertaking or division on the date of transfer. Now 78(1), special provision for full value of consideration in certain case. That is 50C. Earlier was 50C, now it is section 78. Sale consideration less than stamp duty value and difference is less than 10%. So there is a, what do you call this, safe harbor rule. 10% is the limit. If you have to compare the sale consideration and stamp duty value, if it is less than 10%, you can still go with the sale consideration or full value of consideration. If difference is more than 10%, then stamp duty value will be considered as the full value of consideration. Now, there is an agreement when you have to take the stamp duty value. The next question, because in case of immovable property, it will not be across the counter. There will be a sale. So there will be an agreement to sell. Then it will be sold after certain period. So maybe year one means month 1 there will be agreement to sell. Month 4 they may transfer the property. So what it says, which date I have to take the STV value, whether on the date of entering into an agreement or on the date of transfer. Because there may be situation, usually it will not change, but there may be a situation where the stamp duty value on the date of agreement is different, stamp duty value on the date of transfer will be different. In those cases they say, if there is an agreement entered and if fully or part consideration has been transferred or received through specified banking or online mode, then you can take the date of agreement for calculating the stamp duty value, not the date of transfer. So the condition is on the date of agreement, you should have received certain consideration in whatever the modes that has been specified. So date of agreement is not equal to date of registration, and part or full consideration has been received on or before the date of agreement, either on the date of agreement or before the date of agreement in specified banking or online mode, section 66 as per section 66(32). Section 66 subsection 32 defines specified banking or online mode. Specified banking means in case of a check it should be an account paid check, in case of demand draft it should be an account paid demand draft, or any other banking modes, that is it may be ECS, IMPS, RTGS, NEFT, all those things whatever is specified by RBI, that is a specified banking things, plus online mode either through UPI payment or BHIM app, whatever you pay, that is considered as specified banking or online mode. Anything paid apart from specified banking or online mode will not be considered as consideration received. So if it is received in cash or in check which is not account payee or bank draft which is not account payee, it is not considered as consideration received in specified banking or online mode. So the asset may be long-term capital asset or short-term capital asset, and it may be depreciable or non-depreciable asset, but it should be land or building or both. So the nature of the asset should be land or building or both, then only this 50C or section 78 will be applicable.
How is it possible to have stamp duty and self-consideration less than stamp duty?
Yeah.
Stamp duty is always calculated as self-consideration.
No, that is different. You can get the stamp duty value from the registrar. You can get the stamp duty value from the registrar.
Yeah.
Consideration may be different.
Whatever is registered, that is not the consideration of your document.
No. Registered is consideration. Stamp duty value is different. So usually consideration will be more than stamp duty value or equal to stamp duty value. Usually. Now this is a situation where registered value is less but stamp duty value is more. So maybe I don't remember, from maybe 6 to 7 years back, all this Tamil Nadu, this was a problem. Their stamp duty value was more, market value was less.
The assistant officer will come to know about all these adjustments.
What
Because
adjustments?
generally SR value, government guidelines value, that is mentioned in the stamp paper.
No. Mentioned in stamp paper is not government value. So sometimes you pay less consideration, they will take the stamp value based on the stamp duty value. They will collect stamp duty as per the value. Your consideration may be anything, they are not bothered about that. So sometimes you would have seen the consideration will be less, but you would have paid stamp duty as per the stamp duty value. That may be more. So this is between buyer and seller, the consideration will be arrived at. But stamp duty you have to pay as per the stamp duty value. So many things you will get TDS on consideration, not on stamp duty value. What, madam? Yeah, it says part or full amount, but it should be through specified banking or online mode. That's all it says. It won't say what is part. 1% is also part, 99% is also part. So they have not mentioned what is that part. They have not defined that. So they say full or part consideration, but in specified banking. If you receive in cash, it will not be considered. Or account pay, not non-account pay check or non-account pay demand draft. I have not seen non-account pay demand draft. I am not aware. If anybody come to know how is it the non-account pay demand draft, can you explain? I have not come across. Of course, today, off late, we have not seen any demand draft itself. So that is okay. Any other question on that? Okay. Now, there is a situation like the madam was telling. My stamp duty value is more, my consideration is less. As I was telling 5-6 years back, I don't remember exact 5-6 years or 10 years back, most of the sets in Tamil Nadu, especially also, this thing was more. Stamp duty value was more, but consideration was less. They were really struggling. Sir, we are not receiving this much amount, but stamp duty value is more. So in those cases, they can refer to assessee can make a claim that the stamp duty value is more than the fair market value. That is a consideration. So in that situation, the assessing officer can refer this to a valuation officer. But the stamp duty value, whatever is there, the assessee has to pay for registration, and you should not dispute that. You should not dispute or file an appeal against any court or this thing. Only you should make an application that this is more. Then the assessing officer will refer this to the valuation officer. So value determined by valuation officer greater than stamp duty value. Then stamp duty value is the full value of consideration. So some of the different situations where the assessee accepts the value adopted by stamp duty authority. He accepts straight away. He will not dispute. So that will be the sale consideration. Where the assessee has disputed value adopted by stamp duty authority under the Stamp Act. Now he has disputed. Then the stamp duty valuation is finally accepted for stamp duty purpose is taken as full value of consideration. Now he disputes this is wrong. Then they will arrive at that and that he has to accept. The third situation where the assessee claims the value adopted by stamp duty authority is more, but he has not disputed. He has only raised his concern and it has been referred to the valuation officer. Sale consideration will be the full value of consideration if value determined by valuation officer is less than the stamp duty value. So three things are there. One is stamp duty value, one is consideration, one amount determined by the valuation officer. There is a problem. There is one problem in practical this thing. They are still clear in understand. There are three things here: stamp duty value, sale consideration, value determined by the valuation officer. Now sale consideration is equal to full value of consideration if value determined by the valuation officer is less than the stamp duty value. Stamp duty value will be the full value of consideration if value determined by valuation officer is more than stamp duty value. So any situation or any circumstances, value determined by valuation officer will not be full value of consideration. Either it should be a sale consideration or the stamp duty value. Section 79. This is with respect to unquoted shares. I think I can skip this. There is some rule 56 and 57. So this is with unquoted shares, you have to value. Like whenever there is a transfer of public limited company shares, so there should be a valuation. So if it is sold for less than that, then there will be even taxation under 56(2)(10) or 92(m). So if sale consideration less than fair market value, then you have to ascertain that particular value. Then comes section 80, earlier 50D, where if you can't ascertain the consideration for a particular transfer, not ascertainable or cannot be determined, then you have to take the fair market value and date of transfer as a full value of consideration. This is 50D earlier, now section 8. So any transfer of a capital asset where you cannot ascertain the consideration, you have to take the fair market value of that particular asset on the date of transfer. Now we move on to this last three computation sections. 111A earlier, now it is 196, case of short-term capital gains. Equity shares, units of equity oriented fund and units of business trust, where STT to be paid on sale of shares or units. So whenever these three types of assets are being transferred, on sale, STT has to be paid. They won't talk about on acquisition whether you have paid STT or not, but on sale, STT has to be paid. And if that is the case, 20% on such short-term capital gains will be the tax. Some of the additional points: resident, individual or HF. This is resident, it will not apply for non-residents. Individual and HF can reduce the unexhausted basic exemption limit from short-term capital gains to arrive at the taxable short-term capital gains. So suppose your basic exemption limit is 4 lakhs in the new tax regime. and you have other income of say 2 lakhs and you have got short-term capital gains of 5 lakhs. So this 2 lakhs can be adjusted and the balance only subject to tax at the rate of 20%. STT requirement shall not apply in case recognized stock exchange is in IFSC center. So you need not see whether STT has been paid on transfer of shares in IFSC center. Maybe there may be exemption for transactions in IFSC center. That is recognized stock exchange in IFSC center, there is no need for STT. So there you need not see that. Chapter 8 deductions, earlier chapter 6 deductions are not allowed. Then equity oriented fund is defined. Okay. Now coming to 112, S-square 112, now section 197. Capital gains from transfer of long-term capital assets, 12%, 12.5% on such long-term capital gains. Then here also, resident individual HF can claim the unexhausted basic exemption limit. And this is 197.3 which I discussed earlier. So resident individual HF, transfer of long-term capital asset being land or or building acquired before 23rd July 2024. Excess income tax computed as per formula to be ignored. So here earlier 1961 Act there was no formula. They said you calculate as per without claiming indexation at 12.5%, with claiming indexation at 20%, excess can be ignored is what they said. Now they have brought a formula here. E is equal to A minus B. E is excess income tax to be ignored is equal to income tax computed at the rate of 12.5% minus income tax computed at 20% by considering index cost of acquisition and index cost of improvement. So you have to put index cost of acquisition and index cost of improvement, calculate at the rate of 20%. Without that, at the rate of 12.5%, this minus this can be ignored. If it is negative, what happens? Huh? Madam?
Cannot set off.
No, not the question of set off. Okay, there is an example I will explain that. If it is negative, what will happen? If this is less, that is more. Yeah. So there won't be any tax at all. Then 197.4 in case of an assessee being a non-resident, not being a company or a foreign company, from the transfer of capital asset being unlisted shares. We saw about listed shares where we used to convert and all. These unlisted shares, section 72(6), which was talking about converting Indian rupee into foreign currency and all, that will not be applied. Chapter 8 deduction not allowed, and some of the definitions they are given. 197.8 gives the definition of 198. 197 is over. Now it is 198. Tax on long-term capital gains in cases, that is 112A. Capital gains arising from transfer of long-term capital asset, equity shares, units of an equity oriented fund or unit of business trust. In case of equity shares, STT should be paid both on acquisition and transfer. Here, there are three types of assets. In case of equity shares, STT should have been paid both on acquisition and transfer. But there will be certain exceptions. If you have purchased as an IPO, there may not be STT. So there are certain exceptions. Otherwise, if you are purchasing and selling, STT should have been paid both on acquisition and transfer. But in case of other two units, STT to be paid only on transfer of units. Okay, you need not see whether it was paid on acquisition. Long-term capital gains up to 1.25 lakhs is exempted and the tax is at the rate of 12.5%. Additional points here also, like unexhausted basic exemption limit is available for both resident and individual or HF. STT requirement shall not apply in case of recognized stock exchange IFS center. Chapter 8 deductions is not allowed. Central government by notification can specify the nature of acquisition to which STT shall not apply. Like I said, IPO, STT may not be applicable. And rebate under section 156 shall not be allowed against long-term capital gains taxable under this section. So we have 87A rebate. You are aware of 87A rebate. That is not allowed for section 198. Okay. This clause is not there for 197 and 196 and 197. So whether we can claim rebate for 196 and 197. Yesterday 87 rebate, now it is 156 rebate. Whether for 196 situation, 197 situation we can claim the rebate. Yes or no? Okay. So what it says, here it says rebate under section 156 not available for transactions under 198. This clause is not there in 196 and 197. But when you go to 202, which is 115 BSc earlier, so even in 156 it says whatever the tax you pay, whatever the rebate you have to claim, it should not exceed the tax as per section 202. That is 115 BSc, which is new tax regime. So if you are paying tax under new tax regime, you cannot claim the rebate under 156. Was it clear? For all the special rates of taxes, if you are paying the tax under new tax regime, you cannot claim the rebate. And 198 you cannot claim the rebate. But there is a thing where if you are paying the tax under old tax regime and you have income under 196 and 197, still can you claim the rebate. So according to me, you can claim the rebate. If you are charging to tax under old tax regime, not under new tax regime, and you have income under 196 and 197, that is 111A and 112, you can claim the rebate to the extent of 12,500, whatever it is. Still you will be eligible to claim the rebate. But in new tax regime, you cannot claim the rebate for any of these sections. On 198, even OTR, MTR, you cannot claim the rebate. So 198.8 defines equity oriented fund, which says a fund invests a minimum of 90% of its total proceeds in fund B, which is again traded, listed in the recognized stock exchange, and that fund again invests a minimum of 90% of its total proceeds in equity shares of a domestic company listed on recognized stock exchange. Or fund A directly invests a minimum of 65% of its total proceeds in equity shares of domestic company listed on recognized stock exchange. So basically equity oriented fund should have been listed on recognized stock exchange. Either you have to directly means 65% of the total proceeds, or indirectly means a fund will invest 90% and that fund again invests 90% in the shares of equity oriented fund. Now coming to the exemptions, there are 7 exemptions and 89. As is, there may not be much changes in the exemption. Shall we quickly go through exemption and go to the practical things? Huh? Practical thing we will discuss. It's already 8. So okay, any specific change I will tell, otherwise I will go to this thing. Section 82 is the old section 54. Okay. Here it was long-term capital asset. In 54, it said income from long-term capital asset. Now it says long-term capital gains. So whether it makes any difference, we don't know. Long-term capital asset, sale of long-term capital asset being a residential house, it was there. Now it says long-term capital gain. What is long-term capital gain? Gain from transfer of a long-term capital asset. So it should not make much difference here. And other things, that is instead of one house you can take 2 houses, all those things, where in once in a lifetime, if you earn a capital gains by transferring a residential house is less than 2 crores, you can invest in 2 houses. So that also remains same. And last 82.7 and 82.8, if you see, if the cost of asset is more than, a new asset is more than 10 crores, excess should be ignored. So under 54, maximum you can claim is 10 crores. So suppose you have got a capital gains of 20 crores, and if you want to invest 20 crores in a new asset, you cannot invest. You can only invest up to 10 crores. And if you want to keep it in capital gains deposit scheme, maximum 10 crores, beyond that it's not required. Because in the new asset only you can invest up to 10 crores. In fact, we were discussing with CBDT in one of the meeting, the chairman, we were discussing why this 10 crores limit has come to 54. Because you are selling a property and buying a property. So they said mistake has happened. We wanted only for 54F, it has come to 54 also. This we spoke 3 years back. Till today they have not rectified this. CBDT chairman said yes, there is a mistake. He said yes, there is a mistake. We wanted this to only for 54F, but it has been introduced for 54 also. But till today it has not been rectified. Because 54F, why they brought this 10 crores is, many people used to sell these shares and invest in house property. So they want to restrict that cap of capital gains exemption for 10 crores. So that by mistake they have put for both 54 and 54F, still continuing. So 54B is with respect to agricultural land, same thing, no change. 54D also same thing, where there is compulsory acquisition of any business unit. Then this is investments in bond. Okay, here also one change is there. Earlier it used to say long-term capital asset. See, any income from transfer of a long-term capital asset, being land or building or both was there. Now it says long-term capital gains from transfer of land or building or both. So whether it makes any difference. Long-term capital gains is arising out of transfer of a long-term capital asset. But they have substituted that long-term capital asset to long-term capital gains. According to me, there should not be any no difference. Maybe just to bring uniformity everywhere, they have put long-term capital gains. So these are the 5 or 6 bonds where you can invest. Maximum 50 lakhs in the current year, tax year and subsequent tax year. So for 1 year, you can invest maximum. For one computation, maximum 50 lakhs. Earlier, when this section was introduced, if you remember, they used to put 50 lakhs in 1 year, again 50 lakhs in another year, 1 crore they used to claim. 54F, of course, not changed. Then 54G and 54GA we will not come across in our daily practice. That is shifting of industry and taking from urban area to non-urban area. 54GA is urban area or any other area to special economic zone. Okay. Now, there are some more miscellaneous provisions. Shall I skip this miscellaneous provisions with your permission? So that's what my friend said, it will take 6 hours. Okay, 108 shall I take? 108 set off of losses I will take. 108, 109, 111 I will take. Other things I will skip. This advance money received is as earlier. If it is charged to tax and as income from other sources, we will not reduce from the cost of acquisition. Otherwise, advance money received forfeited should be reduced from the cost of acquisition. So, section 108, set off of losses under same head of income. This also all of us are aware. In case of short-term capital loss, it can be set off against both long-term capital loss and short-term capital gains. In case of long-term capital loss, it can only be set off against long-term capital gains. This is under the same head of income, same source. In the same year, if it is loss from house property maximum 2 lakhs, loss from PGVP and loss from income from other sources, set off capital gains is available. How it has to be done? So short-term capital loss or long-term capital loss set off against any of these things. Of course, in case of long-term capital loss, it should be only against long-term capital gains, not under short-term capital gains. This is carry forward of short-term capital loss. Capital loss. Short-term capital loss again it can be set off against both long-term and short-term. Long-term capital loss again it should only be set off against long-term capital gains. And how many years it can be carried forward? The year in the tax year plus subsequent succeeding 8 years. So 8 years is what you can carry forward the losses. Okay. Now the last segment is practical challenges. where all of us may be facing this. I've just noted down 12 situations of these practical challenges. Let us see how much we can do. Sir, I thought same much you do.
ಹೌದು ಸರ್ ನಾನು ಪಿಕಪ್ ಮಾಡ್ತೀನಿ.
Okay. No, because it takes another 45 minutes or something. Those sign ಆಮೇಲೆ ಮಾಡಿಸಿ ಪರವಾಗಿಲ್ಲ, because this is important. Those who want to stay, you can sign afterwards. Those who want to really, you can sign and go. Because it's already 8 ala. So you need not miss this as well. SDV is more than sale consideration. That is, stamp duty value is more than the sale consideration. Is the first one. So what section 78 subsection 2 says? Okay.
Sir, one of my clients' case, seller deducted previous property was deducted on SDV.
On?
SDV. Even though it say consideration was lesser. Now client has received a notice from department saying to pay capital gain on that amount also. There's a huge difference, not 10%. Because sub-register office insisted them, so
They deducted on SDV.
Sir, can valuation officer can be referred for classification of asset like agriculture or non-agriculture? For that reason, can the department go for that?
No,
Can be
valuation officer only for valuation, not for classification. I don't think you can refer. So only for valuation of the property, whether it is STV or that. For that you can refer. For the nature of asset, I don't think you can refer to that.
During the assessment, sir, they will issue 133 to the sub-register officer. At either that time, the same officer can give the classification of that land which has already been sold, saying that that is an urban agriculture land or rural agriculture land. If it is a rural agriculture land, it
No.
will be exempt. That can be happened.
Okay. Shall we go with this? Okay. Okay. So this is STV is more than sale consideration. Without prejudice to the province, this is what subsection says. Whenever the assessing officer, the assessee says that STV is more than the fair market value, and if he is not disputed that, that can be referred to the assessing officer, and he may refer it to the valuation officer. That's what it says, he may. And 78(3) says, if the value determined by valuation officer on a reference made under subsection 2 exceeds stamp duty value, such stamp duty value shall be taken as the full value of consideration. So this is the provisions. Now we will see some of the examples. Scenario 1, sale consideration is 100, stamp duty value is 110. Now it has been referred to the valuation officer and he values at 105. What should be the actual sale consideration? 100. Because that 10% we are within this 10%, 110 to 100, so 100 will be the consideration. Scenario 2, sale consideration is 100, stamp duty value is 115, and now I have referred and he has valued at 120. 150. Okay. Scenario 3, sale consideration 100, stamp duty value is 115, value as per valuation officer is 110.
100.
So valuation as per valuation officer cannot be taken. Okay, now I will say 115 because it is exceeding 10%. It is exceeding 10% because what is that? You have limit of only 10%, right? Safe harbor rule is 10%. Now this is more than 10%, so I will say 115. But I have referred to the valuation officer, and valuation officer has said it is 110. Now the question here is whether I can take value determined by valuation officer or stamp duty value. I can substitute DVDO to SDV and apply this safe harbor rule. You understood what I said?
Yes.
So that safe harbor rule should be between sale consideration stamp duty value, which is 100 and 115, which is now more than 10%. Now I have referred and DVDO is 110. Now whether I can substitute DVDO value to STV value. And now still it is less than, it is within 10%, whether I can take as 100 rupees. So there is a recent judgment which said whenever it is referred to a DVDO and if the value is determined which is less than the stamp duty value, that can be substituted for STV. So earlier it was not there, recently it has come. So there may be other judicial decisions also, but this decision is there where it says DVD value can be substituted for STV. Now I have substituted that for 115, I have substituted 110, and this is within that 10% range, so my sale consideration can be 100. Okay? Now next situation is 100 rupees is my sale consideration, stamp duty value is 90. No. Again I have referred to the valuation officer. And he has arrived at 98. No. So if you see section 78 subsection 3, what it says? What did section 78, 73 says? If the value determined by valuation officer on a reference made is less than, is more than the stamp duty value, then such stamp duty value shall be taken as full value of consideration.
90.
So shall I take 90? So here in this case, can I take 90 as the sale consideration even though I have received 100? Okay. So there are two questions to be answered here. Now, if I make an application where my sale consideration is 100, my STV is 90, still whether I can make an application? First question. If I make an application, should the assessing officer should take this valuation? So here, May it says, May is not discretionary, or it's not only in the month of May, even in June I can ask. So May is not discretionary. If I make an application, the assessing officer should refer to the valuation officer. Now he has referred and it has come. Now if I say 90 I will take, assessing officer can say this shell is not mandated. May is not discretionary, shall need not be mandatory. So he will say, I will not accept 90 because you have received 100, so consideration should be 100.
So this situation will not arrive.
No, just example. I mean, it may not arrive, nobody will go and do it. Just for the understanding purpose I said, May is discretionary, is not discretionary, he has to do, and shall need not be compulsory, so mandatory. So when you have received 100, you cannot go for 90. So just hypothetical situation. The other things you understood, huh? Yes. So next thing is,
Valuation report is based.
sir?
Referring to valuation officer is no use.
Huh?
Referring to valuation officer is no use.
No, if there is no, like 110 means you will get it, huh?
Only comparing 10%.
Huh? Now this is a situation, this is 87A and 88A, 87 and 88. So this is a very rare situation, as I said, shifting of industrial intaking from urban area to non-urban area or urban area to special economic zone. When they acquire the new asset, that should not be transferred within 3 years. So if it is transferred within 3 years, there is a revocation of exemption. There is a mistake in the act itself. So this A1, A2, this should have been reversed. This I have already made a submission to CBDT. So whenever you get some of these things, when you read the act, there will be some mistakes. So please let us know. We will send it to the CBDT. This already we have sent it. And one more in 41 also there is some mistake. Understanding A minus D minus B minus C. What is A and D? It is not matching actually. If you see 41 now, A and D is not matching. A says opening WDV, B says, A says Closing WDV, D says depreciation for the previous year. How it can come? Opening minus depreciation can come. Closing minus depreciation it cannot come. So there is a flaw in this thing. Then this is a situation where you have capital gains from sale of shares and you have to claim 54F deduction. Like you have a sale of shares, equity shares, and that you can use it for investing in a residential house. So let us take this example. Shares A to J is sold. Sale consideration I have taken as 1 crore. Cost of acquisition changes. So there is long-term capital gains and long-term capital loss. So total net sale consideration is 10 crore. Cost of acquisition is 7 crores. Long-term capital gains is 3 crores. Okay. Now there are 3 scenarios. He invests 1 crore in the residential house, or 2 crores in the residential house, or 3 crores in the residential house. 3 scenarios are there. How to compute this? How we will compute this? So there is a problem with the utility. So how you compute in an Excel sheet is different. When you put it in the utility, there is a problem. So you understood the problem means example you understood, no? Now there are 2 things where exemption is claimed on macro level. Macro level was what is this thing? Gain is 3 lakhs. Net sale consideration is 3 crores and 10 crores. Okay. Now at macro level, if you see scenario 1 where he has invested 1 crore and scenario 2 crores and scenario 3 is 3 crores. If you see that the calculation, the exemption available under section 85 is the proportion you will get under 54F. So 30 lakhs, 60 lakhs, 90 lakhs. Is this clear? Is this clear? So macro level I will take 3 crores divided by 10 lakhs. 3 crores is my capital gains into amount invested in the new asset divided by the net sale consideration. I have taken 30 lakhs, 60 lakhs, 90 lakhs. Now I will go on the micro level. I will not go on macro level. I will go on micro level. Sales shares considered for calculation. Only share A I will take in first instance where it is 1 crore. Second case I will take share A and B where the sale consideration is 2 crores. Third scenario I will take sale of A plus B plus C. 3 crores I will take. Now what will be the situation? If you see in under scenario 1 I will get an exemption of 70 lakhs. Scenario 2 I will get an exemption of 1.3 crores. And scenario 3 I will get an exemption of 1.8 crores. So what is the impact of this? So straight away if I go in Excel, if I do, I will get 30,000 or 30 lakhs or 60 lakhs or 90 lakhs. If I do micro level, I will get this much. The difference in exemption available is 40 lakhs, 70 lakhs and 90 lakhs. So this is how you can do share wise, not the total macro level. Micro level if you do, you can get benefit of 40 lakhs, 70 lakhs and 90 lakhs. Deduction. It will allow. We have done that. It will allow. Here 1 crore I am talking, we did for 6 crores. I think it has allowed. But still we have not got assessment order, but we have done that. So last year we have done 6 crores, we have done. So that's what, and it will not allow for loss making shares. Only profit making only you have to do. So even utility will not allow like macro level, micro level only it will do. So this is the difference. If you do at macro level and micro level, it will be a difference. Sir, if you don't mind, I will complete the 12 things are there. I don't think I can complete before 9:30. Okay. No, if you ask question, it may go up to 10 o'clock. So first let me go through, if you don't mind. Afterwards I will take it. For all of you. So I will not answer any questions. I will complete as much as possible. That was clear? Yes. So whatever we do, let us understand. Whether we do 12 or 6, no problem. Whatever we do, we will understand. Now transfer of land or building are both acquired before 23/7/2024. This is a situation where you acquire land or building before 23/7/2024 and you are eligible to compare between 12.5% and 10%. So this is a situation where in case of individual HF, before 23/7 done afterwards, so excess income tax to be ignored. This already I have understood. So this is a case, sale consideration from a residential house is 1 crore, original cost of acquisition is 20 lakhs, purchase one residential house for 60 lakhs. So this is 54, like here of this thing. Now let us see the computation. Now without indexation, with indexation I have done. So there is no expenses, 1 crore, 1 crore. Now cost of acquisition, index cost of acquisition is coming to 40 lakhs, without indexation 20 lakhs. Now capital gains before exemption is 80 lakhs and 59 lakhs. Now if I calculate tax on this, if you see, it will be 10 lakhs and 11 lakhs. Which one you will take? 12.5% you will take. So we will assume that it is, we should go at 12.5%. Should we do at this particular stage? Is a question. The answer is no. You should not do at this particular point of time because there is an exemption available. So what I will do is exemption available under Section 82, that is S5 54. I will claim that 60 lakhs. Long-term capital gains or loss is 20 lakhs or 86,000. So when I claim this, I will get a negative things there. So what will be the tax? Tax at the rate of 12.5% or 20%. At 12.5% is 2.5 lakhs. At 20% it is nil. So what is the formula it says? So this is correct. You have to do after claiming the exemption. As per the formula, excess should be ignored. So questions later. So excess should be ignored. In this case, 2.5 lakhs minus 0, that should be ignored. So there may not be any tax liability here. Okay. So what I wanted to drive the point here is that calculation, that comparison should not be done before exemption. If you are eligible for exemption, don't do the comparison before exemption. You do the comparison after exemption. That's what I wanted to tell you. Next, compulsory acquisition of land under RFCT LARR. Anybody knows what is RFCT LARR? Right for fair compensation and transparency, land acquisition and rehabilitation. Under that particular act, there is section 46 and section 96. So section 46, if you acquire, some private parties acquire the compulsory acquisition, that will not be eligible for exemption. Otherwise, it will be eligible for exemption. Now I have taken a situation where it is acquired under 46, where it is not available for exemption. So this is the amount that an individual purchased 25 acres of land in June 2025, the first paragraph if you see, for 7 crores. Later it was acquired under 46 and TDR was issued. TDS was issued for 18 crores in return. In March 2027, the individual sold this TDS for 20 crores. What are the applicable capital gains tax scenarios? So I have taken this indexation law because it was acquired before 23/7. You are eligible to do this. So the same calculation I have done. If you see the last but one line, under 12.5% it is 1 crore 37 lakh 50,000. Under with indexation it is 1 crore 52 lakh 75,000. So it is not excess. So the tax will be 1 crore 37 lakh 50,000 because it is not exempted under all that particular act. If it is exempted, there won't be any tax here. So first level is doing this. Next is transferring this TDS for 20 crores where the value was 18 crores. What he acquired was 18 crores. That is my sale consideration. If you see the left hand side, first line sale consideration 18 crores. That will be my cost when I sell that subsequently. So it is 2 crores is the capital gain before exemption. No exemption is short term capital this thing. I have calculated the rate of 30% excluding surcharge and cess. So tax liability will be 60 lakhs. So total 60 lakhs plus 1.37 crores. Now here if you see, so for TDRs, it is not a land or building. So you have to see as a right. So you have to calculate 24 months for determining whether it is short term or long term. And in this case, it actually became for 18 months. The day he got the TDR and the day he sold it was 18 months. So he could have waited for 6 more months where he could have converted that into long-term capital asset. So if any situation comes, your assessee comes to you and if he has got this TDR, the time period is nearing to the 24 months, you can ask them to wait for 24 months. So instead of paying at 30%, he can pay at 12.5%. So huge benefit will be there, tax benefit, tax planning will be there. Now comes the JDA situations. So this one, so year 2024, an assessee purchased the land 40/60 in August 2024. Just to avoid this, what do you call this, 20%, 12.5%, I have taken August 24. Now indexation is not available for this. Before 23/7, it's not there. So in year 25, JDA entered to construct 4 houses during August 2025. August 25 he has entered into JDA. STV value of land in August 25 is 1 crore 25 lakhs. When the day he entered into JD, 2 houses and 50% land for owner and 2 houses and 50% land for developer as per the JDA. Developer pays rupees 25 lakhs as consideration non-refundable. In 2026, construction completed in September 26, completion certificate received in October 26. So that is important. Cost of construction for 4 houses is 1.5 crores. STV as on October 2026 for land and buildings is 3 crores. Both land and buildings is 3 crores. Now owner share 50% land plus 2 constructed houses and consideration received. How to compute capital gains in 3 different scenarios. 3 different scenarios we have discussed. One is CC received in October 2026. Owner retains both the houses. Scenario 2. Owner sells 1 house during September 2026 and retains the other house. Consideration 1 crore for the transfer of house in September 26. Scenario 3. Owner sells 1 house during February 2027, that is after the CC date, and retains the other. Consideration 1.25 crores. Now 3 different scenarios. How the this thing works? Let us see. You understood the this thing problem situation. Now scenario 1. CC received in October 26, owner retains both the houses. Only he will not do anything. He will enter into joint development agreement, he receives the 2 houses. So period of holding, from where to when we have to see period of holding. So he has purchased in August 2024 and joint development agreement is entered in August 25. Now the question here is whether I have to see the period of holding till the date of entering into the joint development agreement or till the date of obtaining the CC. The answer is CC. So CC, if you take entering the joint development agreement, it will become short term. August 24 to August 25. Now this is August 24 to October 26, which is more than 24 months. It's a long term capital asset. Sale consideration and transfer of asset. What is sale consideration? Money received is 25 lakhs. Then stamp duty value of his share in the property and the date of completion certificate was 3 crores. His share is 50%. So divided by 2, I have taken 1 lakh, 1 crore 50. Total full value of consideration 1 lakh, 1 crore 75 lakhs. No expenses. Net sale consideration 1 crore 75 lakhs. Now land cost. So he has purchased land for 1 crore. 50% is transferred. So 50% is the land cost. So 1 crore divided by 2, 50 lakhs. And indexed cost of acquisition not available because it was acquired after 23 July. So 50 lakhs is the cost of acquisition. Capital gains before exemption is 1 crore 25 lakhs. Now he is paying tax for these 2 houses and also is investing in 2 houses. He is getting 2 houses. Whether I can claim this under section 54F? Yes. So what is the value? So what I have taken is the total cost of construction of the house property is 1.5 crores. He is getting 2 houses. I have taken 75 lakhs. So 75 lakhs, my capital gains is 1.25 crores and net sale consideration is 1.75 crores. I have invested in 75 lakhs. That is 2 houses. So proportionately I get 53 lakh 57,140. So net long-term capital gains is 71 lakhs. Where I will be paying tax at the rate of 12.5%. I have not calculated the surcharge and cess in any of these things. So it comes to 8,90,860. Some of the points to be noted. as already we discussed. Period of holding to be considered from date of purchase to land of date of CC. Then STV to be considered on date of CC and not the date of JDA. 50% land cost is considered as which is developer share. TDS provision wherever it is applicable, whenever it is applicable, we have to see.
So it is exemption before it.
Now that is scenario 1, sir. Now scenario 1. Now it comes to scenario 2, where he has sold the property before the date of CC. One house he has transferred before the out of date of CC. So one owner sells one house during September 26, before the date of CC, and retains the other. So again, period of holding, August 2024 to September 2026, more than 24 months, long-term capital asset. Here you remember 67, 14, 67, 16 I was talking. 67, 16 says, if you sell the property before the CC date, 67, 14 will not be applicable. So regular provisions will be applicable. So sale consideration 1 crore for which he is selling, then net sale consideration, then what is the cost of acquisition? So land cost I have taken 1 crore divided by 4, 25 lakhs, and cost of construction of building, cost estimates to be obtained from developer, because in this case September, October there won't be much difference. So in this case, so I have taken 3 crores divided by 4. Sorry, 1.5 crores divided by 4, which comes to 37 crore or 37 lakh 50,000. Total cost is 62 lakh 50,000, and capital gains before exemption is 37 lakh 50,000, and I have calculated 12.5% tax on that. Okay. As I said, 67-14 is not applicable in this scenario, but 67-60 is applicable. So regular things will be applicable. Here one thing you have to understand. So here one thing you have to understand. I will come to exemption now. One thing you have to understand here is, I have not done the calculation, but you can think of, here land is short term, sorry long term, building is short term. So in this case, we can say separately land is a long term, building is a short term. So that separate calculation we can make. So now for easy computation I have done that. I have given a note, land can be considered as long term capital asset and building can be considered as a short term capital asset. Here I have not claimed the exemption because scenario 2 is not complete. This is September 2026, there is October 2026. If I go to the next thing, in October 2026, he is having one house. He will get two houses, no? One house he has sold in September, second house he will get in October. So there I have done the calculation, period of holding we are aware. So here money received 25 lakhs, then stamp duty value of his share 3 crores divided by 4. Earlier we took 3 crores divided by 2, this is 3 crores divided by 4, 1 crore. Then land cost 25 lakhs is what I have taken. 75 lakhs is what I get capital gains before exemption. Now, here also I am investing in one house. This is for land I am calculating. First scenario, we invested for two houses under 54F. Here one house I have taken for 54F. So instead of 75 lakhs, 37 lakh 50,000 into 75 lakhs is capital gains before exemption divided by the net sale consideration. 28 lakh 12,500 I have taken. So net long-term capital gains is 46 lakhs. On this, tax on capital gains I calculate 12.5%. So this is scenario 2, two calculations. One in September 2026 and one is October. I can tell you here, it's not that I am an expert in all these things. I have just made an attempt. If something is to be added, we can add afterwards. When once you get this thing, you can go through in detail. If something has to be corrected, we can correct that. But overall, I try to analyze and give you the scenarios. Scenario 3, owner sells one house during February 27. So one house if he sells in February 27, first he receives two houses in October 26, right? So during October 26, owner pays tax as per scenario 1. October 26 he has to pay tax for two houses. So that we have seen 8,92,000 he has to pay. Then we have to calculate scenario 3. Here the problem here is October 26 he got the house, he is selling it February 27. So it will be a short term, not a long term. So he is selling for the consideration of 1.25 crores. And what is the cost of acquisition? Here we have taken stamp duty value was 3 crores. If you see, in October 26 we have taken stamp duty value of 3 crores. Divided by 2 it came to 1.5 crores. Cost of one flat is 75 lakhs. There we took 1.5 crores. In scenario 1 we took 1.5 crores plus 25 lakhs. So here only one house. So I have taken 75 lakhs. So capital gains before exemption is 50 lakhs. You will not get any exemption. On 50 lakhs, you have to pay short-term capital gains at the rate of 30% I have taken, which comes to 15 lakhs. Here also the points to be noted. Period of holding anyway, because it's held for less than 24 months short-term. Section 78 provisions is applicable. STV and sale condition to be compared. Like for land and building, if it is less than the stamp duty, that you have to compare. TDS wherever it is applicable. Here also, land can be long-term, building can be short-term. I have not done the calculation, but that can be done. Now, if you analyze these three situations, so in given scenario 3, in October 26 he pays as per scenario 1 plus for one house in February 27. If I compare all the three scenarios, so in scenario 1, only in October 26 he will pay 8,92,860. He is not selling any property, any house in that. In scenario 2, he is selling one house in September and retaining one house, he is paying a tax of 10 lakhs. In scenario 3, he is paying for two houses and selling one house and paying 23 lakhs. So what does this mean? One is he should not sell the property, or if he is planning to sell the property, he should sell before the CC date. If you see this example, so what I can conclusion is, based on the scenarios outlined above, scenario 1 is more beneficial if the owner's objective is to retain ownership of the houses. However, if the owner's intention is to sell, it would be more advantageous to transfer the rights in the property, scenario 2, before obtaining the completion certificate. So we have to discuss with the client what is his intention, whether to maintain or to sell. Then we have to compute this, whether it is beneficial before selling before the CC or after the CC. So in this example, it is beneficial if you transfer before the CC. So if the client comes to you and when you are planning, and if you feel that before CC if you sell it is advantageous, we can do it. So before telling you should do all these calculations, what I want to do.
Before CC, 2 years should be completed. It should become, before CC, it should become long-term capital.
Before?
Before CC, it should become long-term capital.
Yeah. Correct. Before CC, it should be capital.
So there is one tax is triggering, otherwise 2 tax will trigger.
Correct.
Sir, section 54F violation will not be because he is selling the property. He has claimed exemption.
Yes.
Various.
In the scenario,
The exemption should be reversed.
exemption has to be reversed, like 54F exemption, because he has sold the property within 3 years.
Okay. So that revocation of exemption you are saying. Yes, sir, that may be correct. What you are saying is correct. If you are acquiring a new asset also, there may be a revocation. If you are transferring the asset also, there may be a revocation. So scenario 3, what you said is correct. Maybe some more additional tax may come. You're right. So that maybe I should add that also. What you said is correct. So in scenario 3, where I have claimed 54F for the two houses, and if I am transferring before 3 years, that has to be revoked. You are right. So then again the tax will increase. Instead now itself it is 23 lakhs. Again, yeah, that is one a good point, sir. That maybe I will correct it in this thing. So what he says is correct, because when you transfer that within 3 years, there will be an issue. I think I have not overseen that particular thing. Correct, sir. I will change that. So this is next issue is short-term capital gains from transfer of long-term capital asset. So what we learned is short-term capital gains when you will get short-term capital gains when you transfer short-term capital asset. Long-term capital gain when you transfer long-term capital asset. This is a situation where short-term capital gains from transfer of the long-term capital asset. So this is in case of depreciable assets. So in case of depreciable assets, if it is held for more than 24 months, even though by nature it is considered short-term capital gains, but because it is held for more than 24 months, by its nature it will become long-term capital asset. So why we are discussing this is, because it's a long-term capital asset, you can claim deduction under 54 EC. Now section 78, sorry, not 78, 85, earlier 54 EC, even though it's a depreciable asset, but if it is held for more than 24 months, it will become long-term capital asset, you can claim 54 EC deduction. So there are certain case laws which gives that particular thing, even though if it is considered as for taxation purpose short-term capital asset or short-term capital gain, since it is held for more than 24 months, you can claim 54 EC deduction.
Whether utility is allowing,
Sir?
whether IT or utility is allowing that.
But where utility will come to know about this, sir? No, I don't think whether utility will stop at this. I don't think so. Utility may not stop you from this, according to you. You just claim 54 EC, capital gains in 54 EC, but I don't think, I'm not aware, I've not come across this. But utility, I don't know whether it will stop at that. Because you have to give the sale consideration and capital gains, and 54 EC you have to claim.
We are stating it in the short-term capital gain.
No, short-term capital gain utility will not, you have to say, yeah?
Select any other property, immovable property, like that, we have to select.
Okay. So I'm not aware of the utility, sir. But the law cannot override the, means utility cannot override the law. That's all. If that is there, we have to this thing, make a representation to see that utility will be changed. If that is the case, because law means utility cannot override the law.
What utility is doing 54 EC, they are not allowing it in the short-term capital.
Correct. 54 EC will not be allowed for short-term capital gains, but in this case, you are eligible to claim. That is what it says. There are decisions also which allows you to claim 54 EC. And this time there is a change in the wordings from long-term capital asset to long-term capital gains, but still we say there is no impact on that. So there are many cases which then determination of type of capital asset in section 6710, I think this I will skip. So in case of 6710, where a specified person is receiving specified assets, means assets from a specified entity, how to determine the period of holding in the hands of specified entity? Whether it is short term, long term, how to determine is what it says. So in case of assets, they say the period of holding in the hands of specified entity, based on that they will decide whether it is short term or long term. But in case of cash, that is money distributed, how you will determine is a question. For me also it's a question, for you also it's a question. So somebody said that based on the, if it is a goodwill, so based on the period of stay of the partner or based on the period of stay of the entity, that may be decided. But practically I am not done that. If anybody has done, you can let me know. Whenever the specific entity pays in the form of cash, or that is bank balance. So how to determine the type of capital asset, whether it is short term or long term. Then a residential house versus one residential house. Earlier the act said a residential house. Okay. So we know, I think one chart account was there in Bangalore, Mr. Venkatesh, S. Venkatesh. So he was arguing, and one of the case he said, A doesn't mean one. A means doesn't mean one. It can be, it's only a residential house. A residential house, not one residential house. It can be more than one. So that was his argument, and of course he has won in one of two criminal cases. And one of my friend, he was arguing one case named Sachin. One of his client had purchased house property outside India. So 54, I have sold the property in India. I have invested outside India. The tribunal said it's not allowed, but he said no. Nowhere it says only house property. I have to sell, house property I have to get. So that also case he won. But then there was an amendment where it said A has become one residential house, and they have also introduced in India.
Sir, but reverse case still not, solution is not there. Selling a foreign property and making investment in India. beyond there, the case is pending.
No, sir. Reverse case, why there is a issue? If you are a resident, global income is taxable. When once you earn income from house property outside India, that is charged to tax in India. If you sell a residential house outside India, you purchase residential house in India, you will get that. If you purchase outside India, you may not get.
Yeah.
That is there. In India now it has come. You sell property outside India, but purchase in India, still you should be here. You should be
Right now
available.
also we have only two cases recorded. One is favorable and one is against us. Both are criminal cases. We are just waiting for.
No, but in India you should get it according to me. Because when income is there, you are offering for tax, no? So then in India you should be available. So this is how two people from Bangalore they fought and now they changed the law. A has become one and in India has been introduced. So 82.5 where I said when a person transfers house property and the value is 2 crores capital gains, once in a lifetime he can invest in two houses, so one can be read as 2. 86.1b, one house in India, of course these are all 54F cases where you get multiple flats. So that 54F we claim, no, 2 houses we claim, but they may not be allowing for 2 houses. So there are decisions where more than one house is being allowed, and most of the decisions are from Karnataka High Court, KG Rukmini case and D. Anand Basappa. So every case to case basis you have to see. But one thing you should understand is it should be in the same block. So in this Rukmini case, 4 houses was in the same block and they allowed. And in Anand Basappa case, it was 2 houses. Like 2 houses means one house here, one house on top, which was a duplex they said. And in another case, one house here and one house here next to that, they made it one house. So like that it is there. So case to case basis you have to see, and if the first thing is it should be within the same block, same building. It cannot be in one block one house, another block another house, you may not get it. It will be difficult for you to fight the case. So more than one house also, there are chances under 54F in case of joint development you can claim the deduction. Then claiming of management fees paid to PMS. Now all these PMS wealth management companies are there and high net worth individuals, they invest in PMS and they pay management fees. Whether that can be claimed as a deduction. See, a few of the clients we have claimed that expenditure, and there are some favorable decisions and unfavorable decisions also. It's your good luck or bad luck. So when you claim, maybe you can talk to the client, this is the decisions based on their yes or no, you can claim that particular management fee expenses. No, not cost. What we do is while calculating, we will reduce from the as an expense. We will do it, sir. Was in the Excel only, we will do it and take it as expenses. That's what we do, right?
Others we have to do proportionally so many.
Yeah, proportionate only we do, sir.
So many shares.
We will do so many. 3,000, 4,000 line items we do those, sir. Not one or two. And this is all high net worth individuals, management fee may be 7 lakhs, 8 lakhs, but the value of sales may be in crores. I have to allocate everything, where formula we do that. Of course, we have done a few cases, we have not received anything. Okay. We have got more than that, maybe, or maybe 1,000 to 1,500 also. Investment in CGDS account, this is one thing I'll say. This is the section which says all the subsection 2s, all the 88, wherever CGDS, that is capital gains deposit scheme is the subsection 2 of all the section 82, 83, 84, wherever it is applicable, it deals. It says if capital gain is not utilized by the state to purchase new asset before filing the return of income under section 263. It says under 263, another 5 minutes pa. Sit down. I know it's getting late, 5 minutes will close. So it says under 263, two subsection A says the unutilized amount should be deposited in a specified bank or instrument and placed as per the scheme notified by the central government. 263 has got 4 subsections. 263 one is regular return, 263 4 is belated return, 263 5 is revised return, 263 6 is updated return. Now the question is, when I have to invest in the capital gains deposit scheme?
Before filing the return.
Yeah, before. So the preamble says 263. The preamble says 263, and 2B says such deposit should be made before filing the return of income under section 263(1). So there is a conflict between the preamble and the subsection. So it was there in 1961 Act also, 139 and 139(1), and still continues. Maybe we have to write to the CBDT to clarify this, or to amend that 263 to 263(1). But there are situations where people have not filed the return, not kept in the capital gains deposit scheme, but they have invested in the new asset, which was allowed. There are instances, say you have to acquire the new asset within 3 years. You will not file the return, you will not keep it in capital gains deposit scheme, but you will acquire the new asset, you will get the deduction. So then the proof of deposit should be submitted, and what are the things, how to do it, opening, where to open in all the national bank or authorized private banks, what are the modes, savings bank or fixed deposit, application to open the account is Form A, then operation, conversion of FD to SB or SB to FD you can do using Form B, for first withdrawal Form C, for subsequent withdrawal Form D, and cannot use checkbook or debit card. Okay. And interest fully taxable and TDS will be deducted by the bank. On withdrawal must use within 60 days, otherwise you have to deposit back. Closing, account closure Form G. Now Form E and F we have removed this, we have not said. E is for nomination, F is for changing the nomination, correct? So our people have done all this R&D. So closure, account closure is Form G plus form approval letter from regional income tax assessing officer. And if you open in SBA, they are more stricter. So other banks I have heard that they may not be that much stricter. You can use 1,000, 2,000 and you can close the entire thing. But of course, we cannot guide that to the client. Whatever they withdraw, they should use it in the new asset. So the last one is F&O losses to be set off against capital gains income.
Losses, business losses.
Yeah, in SSC as following income. Income from salary 2 crores, income from house property 7.5 lakhs after calculating all these things. Loss from PGBP, turnover is 2.5 crores, that is F&O losses. Cost is 4.5 crores, loss is 2 crores. Income from capital gains is 3.5 crores. Income from other sources is 20 lakhs. The computation, if you see, income from salary is 2 crores. Income from house property is 7.5 lakhs. Now, I'll take this is a loss. That's a business. So I've taken as 44 AD, 58 now. So 6% of the turnover of 2.5 crores I've taken, 15 lakhs. Income from capital gains 3.5 crores. And income from other sources 20 lakhs. Total income 5.92 crores. Tax payable including surcharge 1 crore 41 lakhs 25,312. Is it correct? So if you calculate based on the information, this is what it gets. 1 crore 45 lakhs he has to pay. Now what we will do is, this F&O, we will say, we will maintain the books of accounts and do the audit. We will not do like this because he is eligible for 44 AD up to 3 crores. So I will not do this. I will tell him to maintain books of accounts and do the audit. Now income from salary is 2 crores. Income from house property is 7.5 lakhs. I have done the audit. 2 crores is the loss. Income from capital is 3.5 crores. I have adjusted. Income from other source 20 lakhs. Total income after inter-rate set off is 3 crores 17 lakhs. Tax payable is 93 lakhs 8,000. The savings is 48 lakhs. What you will charge is up to you. But if you don't tell to the client, this is what we can save like 48 lakhs if you just miss something. And it's all tax planning only. It's not that something we are doing.
Do we have to maintain proper books of accounts tally or something? Not.
Okay, you have to maintain. We maintain that. You charge. You have to charge for the audit also. So if you do this small tax planning, which is legally available, you can save in these cases almost 40 lakhs. You can save. So this is what I would like to place before you. Of course, some of the things I missed out because of time constraint. Once again, I thank Bangalore branch for giving me this opportunity and each and everything for giving me a patient listening. Of course, Vaibhavi is there, you can stand. She also supported me in all this preparation and also all the technical support. we discussed so many things and we prepared and even the PPT she helped me
Share
out.
the PPT on time.
Yeah, I will share. So I want to correct that scenario things as I said. Maybe afterwards I will share if you don't mind. Huh? Afterwards we will share part. One change I have to make. So thank you all for enlightening me also. So there will be many more things, practical things. Maybe you can share in other occasion. Thank you.
Thank you. Thank you, Cotha Srinivas sir. I'm sure it was insightful and a lot of practical experiences that you have shared with the members. Thank you, members, for your patient listening, and do visit our website for upcoming programs also. We have a lot of programs relating to CAA as well as Yoga Day as well. Thank you so much. And also I'd like to thank CA Cotha Srinivas sir for being our speaker today. On behalf of Bangalore branch, I would like to,